Welcome to Yahoo Finance Live. I'm Rochelle Akufa alongside Brad Smith. Happy Jobs Friday to all who acknowledge it. Brad, I want to first get your take. We'll be getting that data in just a few minutes here. Expectations looking at about 170,000, give or take. We'll have to see if we get any surprises. What are you watching for?
Yeah, ton to keep an eye on here, whether you're looking at the sectors to see whether we continue to see a rebound in leisure and hospitality, or whether you're looking at wages to see how much more difficult the Fed's job gets from here. Of course, even as we're taking a look at that year-over-year wage growth, perhaps a lot of investors keen to keep a close eye on this coming off of the ADP payroll data that ultimately showed us and gave us a little bit of the inclination coming into this report where we've still got a little bit of work to do as a result of wages being higher, but inflation also a byproduct of where the Fed is going to be thinking about their broader calculus and how they are going to do their dual mandate inflation busting here, and wages certainly make that job harder for the Fed. So keeping an eye on that year-over-year wage growth and, of course, the more kind of not cyclical, but more sequential reading of that as well. That's going to be something that I keep an eye on. But then additionally here, I'm just keeping an eye on a few sectors. Of course, I mentioned leisure and hospitality. That's an area that was hardest hit earlier in the onset of the pandemic. But this is also a report where we could see in the education or the state and local government and education trickle down there, a cyclical or seasonal bump back up there, especially given the fact that many teachers, once it comes time for the summer, not as many of those positions are still accounted for. So this mid-month to mid-month reading, we'll start to see some of that show up perhaps in education, and private education might be interesting to keep an eye on as well, just to see where teachers might be making shifts, given the fact that they have been underpaid for so long, many of them now, and especially with the attrition rate and turnover, looking at how they can make sure that they are outlasting some of the higher costs of living themselves through wages, and looking perhaps in private education for some of those opportunities as well, Rochelle. What about you? What are you watching?
Yeah, you raise an important point about some of the nuances. I mean, if we base it on what we've seen with this continuing trend, what we saw with the JOLTS data coming in at 8.8 million, things do seem to be trending lower for these job openings, shrinking so far this year. And it's also reflecting what indeed the job search platform is also seeing. They're seeing fewer jobs available per person. They're seeing people are quitting less. And of course, much to the chagrin of the Fed, we haven't seen, though, a meaningful jump in the unemployment number, which is something that they'd be really banking on to really sort of give them a bit more wiggle room when it comes to either keeping rates as they are or perhaps easing back on some of the rate hikes. And we're also seeing that some unique factors to keep in mind. I mean, you have the ongoing SAG-AFTRA job strike going on at the moment. Economists at UBS expecting that to be an 18,000 jobs hit there to the monthly data. And also keeping in mind what we saw from the recent Chapter 11 bankruptcy of Yellow Trucking. Now, that's expected to be a loss of 30,000 jobs. So some things in there that might skew the numbers or be sort of a one-off here, Brad, to keep in mind. But, it's a pretty wide range, but still expecting that 170,000 number. It would be more of a surprise if we saw this big jobs number come in and sort of do the opposite of what we've seen the JOLTS data and ADP data doing.
Yeah, let's give an outlay of some of the futures right now as we are coming into this report. We've got just over a minute left until that report drops. Taking a look at the Dow, the S&P 500, and the Nasdaq futures, which, it was a tough go of it for the month of August. Now we begin a new month, a new jobs report to really kick things off here, and another consideration for the Fed going into not just their September meeting, but of course going to be looking for some broader trends that they perhaps take into the November meeting, which is showing more probability that they may make a decision to hike rates once again. But taking a look at the futures right now, up across the board for the Dow, the S&P 500, and the Nasdaq, fractional gains as of this point in time. And you got to wonder going into that November meeting as well. Of course, September widely kind of put to the side as of this point by many investors, or at least by the CME FedWatch probabilities that we're tracking here. But particularly as the Fed gets towards that November meeting, where they may see further spots of weakness within the economy. And I kind of lean back on one of the kind of overall reads that we got from BlackRock's Rick Reeder just a few days, maybe last week it was, where he said that borrowers today in the economy are lower income. Savers, wealth accumulators, higher income, higher rates. overly regressive tax on lower income households and consequently expands the income and wealth gap in the country. It'll be interesting to see where the Fed and the FOMC voting members also give any weight to the policy decisions there. And as we've struck 8:30 Eastern time, we've got the 187,000 jobs number that is just broken. 180,000 jobs added during the month of August, or the month of August here. And we're taking a look at the futures reaction, as you've seen there on your screen. But as of right now, kind of holding steady, moving a little bit higher here. But that tops expectations. We're seeing that come in at 187 versus the 170,000 jobs that were expected. And then additionally here, looking for the unemployment rate, looks like that actually ticked up to about 3.8%. The expectation was for that to remain about 3.5% there. And then just looking through some of the average hourly earnings year over year, that ticks lower to 4.3% there. So some easing in the form of the wages, and then additionally and a higher unemployment rate, and then additionally a higher or better than expected reading on the overall number of jobs added. So there you're taking a kind of overall look, and we'll dive into some of the specifics within this report as well, Rochelle. But particularly as we're looking at the stock reaction, the futures still actually edging higher here. And interesting to also note here within this report, employment continued to trend up in healthcare, leisure and hospitality, social assistance, and construction, while the declines were really in transportation and warehousing there. So those some of the early reads that we've got as of right now, Rochelle.
And certainly, as we were just mentioning there, watching for that unemployment rate to tick up, as we're seeing there now at 3.8%. Now, this should be welcome news for the Fed, because that's really been a very stubborn number that hasn't been rising in correlation with some of the job openings that we've been seeing. So some welcome news there. So no surprise that we're seeing futures on the rise there, giving the Fed a little bit less work to do. But this is a very data-dependent Fed. They say 1 month does not a decision make. Still mostly expecting a pause at the September meeting. So this does take a little bit of pressure off there. And I'm sure perhaps we'll be waiting to hear some kind of word from the Fed at some point to try and take some of the heat off, try and calm some of this enthusiasm. As they said, there's a lot of information that's going to come out between now and November. So I'm sure they don't want the markets getting too ahead of themselves, but at least for now, making things a little bit easier for the Fed, Brad.
Yeah, I'm doing some quick Control Fs or Command Fs for all my Apple users out there. Labor force participation rate rose by about 0.2 of a percentage point during the month. That came in to 62.8%. And then the employment population ratio, that was largely unchanged. What's important about that labor force participation rate, that was roughly flat, basically flat since the month of March there. So a slight tick higher there. And we'll get a little bit more color on that in just a moment from our guests who are joining us in studio. I'm sure that our viewers want to hear from them. But first, let's go on over to Jared Blickery for a look at how the markets are reacting to August's job report. Thanks so much.
Yes, well, let's check it out, because we have markets that were already up, at least in the futures before the report. And you can see we got a little bit of a bump up right here. This is the Nasdaq 100 futures, and there is right before the report. We are up about, 20 basis points or so, and we're up about 40 right now. S&P 500 a little bit more, Dow a little bit less, and the Russell 2000, that is actually the best off, it looks like. Looking at RTY futures, they have surged, and they are now up about 74 basis points or 0.75%. Let's check in on what the bond market is doing. I'm going to take a look at the futures. Here are 10-year Treasury note futures, those are up about 24 basis points, 0.25%, and you can see they were just about flat before the report. These move inversely with respect to yields, and so a little bit of an up move here means that 10-year yields have moved a little bit down. It's going to be interesting to see how we shake out the day at the end of the day here, 3 p.m. for futures, 3 p.m. for the Treasury mark, 4 p.m. for stocks, because we usually get a little bit of a movement. We get a retracement into the opening hour, and then maybe it's off to the races. But we usually do see some kind of a fake out within the first hour of trading. Here are gold futures. Those have surged higher, maybe just thinking that because of this mixed report, the Fed can step off the brakes just a little bit. Also going to take a look at WTI crude. This doesn't usually move, and we're not seeing it move much here today, but sometimes it does, so I do want to take a look at it. And here's Bitcoin. Bitcoin has been highly levered to the Fed at times in the past, but it has been very sleepy lately, except for a couple days. You'll see some action. It'll be up 5%, and then it'll go to sleep for a few days. For what it's worth, Bitcoin also joining the risk on party. And finally, I'm just going to check in on the sector action to see which sectors are surging. Energy, I believe that was up the most before the report and up about 0.9% after that. Real estate, financials, consumer discretionary, industrials, and materials, all of those up more than 0.5%. It looks like we have time for one more look at the crypto market here. I just want to get an overall picture. Here we can see Bitcoin down 4% overnight, so actually having a little bit of a slide. Let's take a look at the year to date and chart that price action here, and we can see we have given back those gains from the favorable ruling that we saw in that Grayscale Bitcoin ETF case. So that did not clear 30,000 the way a lot of I guess market participants had hoped for that. All right, hope you guys appreciated that slide into Bitcoin, and I'm going to send it back to you.
Yeah, Jared, we're going to decrypt a little bit more of this employment situation report that's just dropped here. Appreciate that rundown of a lot of different areas of the market as of right now and how they're reacting to the August jobs report. We're joined by Dana Peterson, who is the Conference Board Chief Economist, and Joe Bruce-Willis, who is the RSM Chief Economist. Great to have you both here in studio with us and helping us break down some of these figures here this morning. Dana, I'm going to begin with you. Kind of, you look at this report. What is this set up for the decision that the Fed has in front of it in September and perhaps even November too? Anything that jumps out to you?
Well, what really jumped out to me is that you still have this kind of three parts of the labor market where you have the former pandemic darlings cutting, which included transportation, warehousing, and information, and also temporary help. But also you still see strength in those areas like leisure and hospitality and healthcare. Meanwhile, everyone else is just kind of sitting tight. So I think this is still the same situation that we've seen. Also, there were downward revisions in the payrolls for the last 2 months. So the Fed should look on that favorably. But certainly we had yesterday's inflation data, which weren't really going in the direction that the Fed wants. So I think the Fed may still want to wait for those long lags to kick in and come back in November and maybe hike then.
And Joe, Rochelle here. I want to ask you, I mean, obviously people had their different estimates going into this. This is a pretty bumper report here. What are your big takeaways?
All right, this is another rock solid American jobs report. We see we see hiring cooling. We see wages cooling. We saw 110,000 downward revision to the past 2 months. This plays into exactly where the Fed wants this jobs data to go and sets up nicely for a September pause. Now, in terms of the big takeaway, just a little quick math here. When I looked at the higher wage component, 174,000 of the 187,000 jobs created were goods producing, construction, manufacturing, private healthcare, so private education. So we still are hiring at a pretty strong clip here. Look, we've got a significant problem in terms of labor supply in this economy. Even as the economy slows later this year, you're going to continue to see unemployment bounce between 3.6 and 4%, right? We're just not going to see that big jump in unemployment like we've seen during past slow periods. So this is going to be very interesting in terms of the policy interpretation and the forward guidance. Look, lastly, out in the real economy, financial stress is actually up a bit. And the long period of rate hikes is really beginning to take that pound of flesh away from financial actors. Firms are really having a problem finding capital to invest. This is going to be an ongoing narrative, I think, as we enter into the final stretch of 2023.
What about financial stress for individuals and households, Dana, as well? I mean, I'm looking at one of your quotes from the Conference Board and the monthly reading of consumer confidence here. How does this play in and the employment situation and employment conditions into consumers' mindsets right now?
Well, I think it's definitely weighing on the consumer. In our consumer confidence measure, they were less ebullient about jobs. They're saying jobs are not as much available now, and they're worried about the future. And hence, they're also worried about their finances and income. And I think that all coalesces into kind of a bad story for consumers. Many of them are running out of that excess savings. It's probably going to be depleted by, in the next few months. And they're spending using credit cards, and we're seeing delinquencies rising, and even among banks, especially small banks, charge-offs are rising. So consumers are definitely under stress. And that, let's not forget, there's also the student loan issue, where at least they're going to have to start paying the interest starting in October. So slower income growth, higher debt, and payments for student loans suggests that we're going to see slower consumer spending. And I think consumers are starting to internalize that, at least in what their sentiments are saying.
And Joe, even as we look at the underemployment picture as well, how should we be viewing that as we're trying to really get a gauge on the health of the labor market here?
Labor market's absolutely tight and rock solid. Look, unfortunately, we have a bifurcated market. The 5 decades of economic inequality that's developed. Dana just made a very good point talking about down markets, the 3 lower quintiles. Unfortunately, the upper 2 quintiles of income earners are responsible for over 60% of spending. Right? The economy is just not going to turn over simply because down market individuals are still having a hard time adjusting to the higher price level. And clearly, no one's happy with the recent uptick in the price of gasoline. But my sense here is that you're going to see some very strong growth here in the third quarter. Now, we have 2.1%. We're going to have to revise that up after we've seen this week's data. And then we'll see a bit of slowing, I think, at the end of the year. But I got to tell you guys, the recession that a lot of the big banks called earlier this year, it's just not materialized, and it's not going to happen.
So there's nothing within this report to you that screams recession?
Nothing whatsoever.
So in this instance as well, when we think about the consumer that, sure, on the higher end might not be breaking, but they certainly are bending, and that's showing up in some of the earnings results that we've seen as even companies in Walmart are saying that they've got more high-income consumers
does
coming
not
to their stores.
Account for where high-income consumers spend.
Just because a couple of stores.
Okay, just because a small number of people come in, you don't want to overgeneralize and say cracks are forming in the upper end.
Sure.
They're not.
Right.
The problems are down market. I see problems in Target, I see problems in Walmart, but they're serving a cohort with $70,000 or less mostly in their households. What we're really talking about is an economy that's just going to continue to move along despite the stresses and strains. And admittedly, student loans are going to pick back up next month. That's going to cause overall spending to slow. But when we take a step back and we look at the overall economy, there's enough cash in the system to get through the rest of the year. And remember, wages are increasing at a 1% per annum peak. When you saw that personal income report yesterday of 0.8%, that's what's driving it.
So Dana, are you also expecting a recession then when you talk to some of the consumers and the CEOs out there? What are their recession expectations?
Sure, consumers are on the cusp in terms of thinking there may be a recession. For much of the year, that expectations gauge in a consumer confidence index was below the 80 threshold, which means recession. And it popped up and now it fell back. CEOs still think overwhelmingly 85% think that there is going to be a recession. It'll be short, it'll be shallow, not too bad, but still a recession nonetheless. And the thing is that there's still other pieces of the economy, right? Housing is still very, very weak. We don't see that coming back until interest rates start to fall. Businesses are pulling back on investment. Certainly, we've seen that in IP and in equipment, and we saw downward revisions the other day in investment. And let's not forget the debt ceiling deal means that there is going to be spending cuts on the government side, whereas government spending had been supporting the economy through investments in R&D and infrastructure. So we still see that there's going to be this coalescence of negatives. And certainly there are very long lags with respect to monetary policy. And that's going to play out, we think, towards the end of this year, early next year.
Joe, you mentioned that this is the report that the Fed wanted to see. It checks the boxes for them on many different metrics. And so now, as we kind of think back on the entire week of economic data that we did get, is there one outsized piece of information that you expect them, at least in their tone or in their conversation, to really linger on a little bit more?
Well, I think that when you take a look at, say, the quits data inside the JOLTS report, quits data is a robust predictor of wage gains. And when you see the quits coming down, wage gains are going to slow going forward, and that's going to help out on inflation, and that lays the predicate for a pause in September. Now, most of us in the business have already moved past September. We're thinking about November. Right. Because if they don't end up increasing then I think we're at the cyclical peak in policy rates. Then we can start thinking about what 2024 looks like. You know, as inflation comes down, real interest rates go up. And at a certain point, the Federal Reserve has to begin focusing on stabilizing that real interest rate in order to make sure that they don't tip over the real economy, which, hey, look, it's not growing at 4 or 5%. But it's growing at 2%, which is above the 1.8% long-term trend. And we don't need to have another policy error, which results in tipping over the economy and an unnecessary recession, even if that means muddling through for another year until we really get inflation in the rearview mirror.
And Dana, we heard from Philly Fed President Harker really talking about giving a chance for some of the Fed's medicine to really sink into the economy. Does this obviously gives more strength to his argument as we're starting to see some of this this movement in the loosening of the labor market here? But do we really need another rate hike, do you think, by the end of this year?
Well, that really depends upon the data, and the Fed is data dependent. What happens with inflation, especially core inflation, is going to be critical, as well as with wages. Wages overall are slowing, but you still have individual industries that are seeing wages rise. And it's mainly those industries where you have to physically show up to work, and also in those industries that are suffering from labor shortages from baby boomers leaving and taking their expertise with you. And again, those are many industries where you have to physically show up. So I think that's going to be important. The evolution of employment and also the hard data in terms of retail sales and consumption. All those pieces are going to matter. But in terms of the lags, different aspects of the economy are affected at different times. So we saw interest rates rise and the housing market immediately responded. Then we started seeing businesses respond because the cost of capital was rising. The last piece of the puzzle is the consumer. And we think that the consumer is going to run out of steam. Certainly when you look at the credit card usage, there's still a lot of consumers who really can't afford what they're spending. And certainly, how many vacations are going to go on in 1 year? All that's going to run out of momentum, we believe, and that's going to reflect the monetary policy that's already been put into place.
I do appreciate both of you joining us. A big thank you there to Dana Peterson, the Conference Board Chief Economist, and Joe Brasuelas, RSM Chief Economist. A big thank you to you both. Let's give you a quick recap of those jobs numbers coming in with that surprise. They're topping forecasts. Non-farm payrolls coming in at 187,000 versus the 170,000 expected. That unemployment rate ticking up to 3.8%. Average hourly wages holding steady year over year, though, at 4.3% there as expected. Seeing that rise there. Obviously, a lot of fodder for the Fed to consider, but a lot of data between now and November for the Fed to consider that.
That's right. Coming up, you know Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's next.
The US added 187,000 jobs in August, with the unemployment rate ticking higher to 3.8%. Joining us now with more on the August jobs report, we're joined by Evan Sohn, Recruiter.com chairman and CEO. Good to have you on, Evan. I first want to get your reaction to this stronger than expected number we've seen today.
Well, we track the Recruiter Index, and the Recruiter Index is a survey of recruiters. We've been doing this since the pandemic. And the August Recruiter Index was the lowest in ever. It was 2.7 out of 5. It's the fourth month in a row of lower numbers. So very disappointing. And we weren't surprised by the low under 200,000 number. We're also not surprised by the 3.8% increase in unemployment. We were tracking about 160,000 people that were laid off from the during the tech the actual tech layoffs themselves. Sorry, and about 35% of those folks were still unemployed 9 months later. So we weren't surprised by the unemployment, by the increase in unemployment numbers.
Evan, when we think about the shrink that's taken place, the shrinkage, I should say, not to be confused with what we're hearing from some retail companies, in terms of the openings that are being posted right now, how rapidly do you expect that to continue?
Well, look, the answer is that there was certainly an overhiring taking place at the beginning of 22. There was a correction that took place throughout 22. I think companies are now much more reluctant to overhire. They're leveraging generative AI technologies to figure out what roles could be automated, what roles could be augmented, and the combination thereof. And also, often the startup companies, and we've seen just a tremendous number of startup companies in the AI space. We were tracking folks that left OpenAI to start new AI companies. Those companies need fewer people than before. So in terms of actually starting up companies, venture capital is actually not flowing as much to non-AI related companies. So it's going to be a challenge in terms of getting new jobs open.
And Evan, what do you think are going to be the key themes that dominate the next wave of the job hunt? We mentioned AI, but as companies are sort of thinking about this differently, trying to manage costs as well, and then you have a tight labor market where they know, perhaps employees don't have as many options as they used to. What are some of the key themes that you're looking at?
So I think the biggest challenge that we have is, you look at Salesforce.com, who announced great earnings yesterday. The result of their earnings was not entering a new market. It wasn't that they had a new product launch. It was that they actually cut costs to get their earnings in place. And Wall Street's rewarding companies for achieving their earnings through cutting costs. Cutting costs typically means reducing your supply chain of labor. So I certainly think there's a challenge there. And we're also about to see this incredible shift in terms of companies taking advantage of generative AI, what roles and the movement of roles, et cetera. At the same time, we have this challenge of companies saying thou shalt return to office full time or 4 days a week, whatever those numbers are, which is also a changing dynamic. So I think you're going to see that. We were not surprised by the decrease in quit rates. We track the JOLT report very, very closely. We were not surprised by the quit rates because it's the summer. And often people are thinking about leaving their job after Labor Day. New rules are kicking in after Labor Day on companies. And so we were not surprised that the number was lower in August. Let's see what that looks like now as we exit Labor Day.
Three of the largest, and I'll bring it out to four of the largest sectors that had the most growth, at least in this most recent month, according to the employment situation: healthcare, leisure and hospitality, social assistance, and then construction as well here. And that continues to tell us that labor is in need for some of the most labor-intensive sectors as of right now. What does that tell you about the broader state of, not just for these industries, but more broadly, where there is still some hiring or major hiring still to be done in the economy?
So healthcare, we've been tracking healthcare as the #1 in-demand industry, according to the Recruiter Index. And we've been tracking healthcare for a long time as the #1. Not surprising. It's required to be in person. There are constant increases, and there are efficiencies that healthcare organizations are getting in terms of expanding the overall nursing pool, So we've seen that very, very high demand in terms of the overall healthcare sector. And I think it was the #2 job in the U.S., according to one of the reports, in terms of opportunities for healthcare workers. Certainly on the nurse practitioner was a very high sought-after role. But you're seeing the roles that are in person, intensive labor, in-person roles, being those growth-oriented roles. We're probably going to see that seasonality that we usually expect sometime in the fall for the Christmas time be a real challenge now, as we're seeing more and more retailers close, shifting over to online. So I think it's going to be a real challenge over the next couple of months.
Evan Stone, Recruiter.com Chairman and CEO. Evan, thanks so much for taking the time here today to help us run through some of these jobs report numbers. Appreciate it.
Thanks so much.
Well, let's do a recap of the August jobs report. 187,000 non-farm payrolls added during the month. Unemployment that ticked higher to 3.8% above expectations there. And average hourly wages that actually moved lower but came in line with expectations. That sitting about 4.3% year over year. Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Halley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finances next. Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith, alongside Rochelle Akufo. Here are 3 things that you need to know to start your morning and your month of September. The August jobs report tops expectations at 187,000 jobs added. That's ahead of the 170,000 that was expected, but still shows a cooling economy. Importantly, wage growth is also cooling down, setting the Fed up for a widely expected September pause. Equities look to start the new month on a positive note, a month that's traditionally not a great one for stocks. Lululemon's ambitious growth plan looks like it's working. The retailer ups its guidance thanks in part to a very strong performance in China. The athleisure giant saw revenue spike 61% in the world's second biggest economy. It now sees sales between $9.5 billion and $9.6 billion for the fiscal year. Sales in North America, they were up 11%, and the business says it's in a good position on inventories. And the TSA is expected to screen more than 14 million passengers during the Labor Day holiday weekend. Today will be the busiest day with over 2.7 million travelers passing through security checkpoints. It's not a great time for a tick higher in gas prices, but it's happening. The national average is up from a month ago at $3.82 a gallon, $3.82. My goodness, Rochelle.
Certainly been feeling that myself as well. Well, speaking of things being busy, a busy week for corporate earnings and economic data. As we enter the first trading day of September, let's recap some of the biggest lessons that we learned this week. First up, lower income households are feeling recessionary. I mean, we're seeing people really pulling back more than ever. We heard it in the earnings calls. We know that people are really bracing for what we're seeing with student loan repayments set to start back up. And so I think every little sort of seed that's being planted that's saying, look, the consumer has run out of that pandemic money. They're trading down or trading off some of these more expensive things. And then when you factor in, when you look at those big gas prices on top of everything else, it's a very tough time for the consumer right now. And it's starting to show up in some of the price action.
Yeah, one of the acknowledgments from BlackRock, the kind of lower income parts of the economy are certainly feeling a little bit more of the pressure, especially considering the extent to which inflation has need to be combated to this point. And particularly BlackRock's Rick Rieder, who had said off the back of Fed Chair Jay Powell's commentary, even in Jackson Hole recently, saying that the higher rate right now is an overly regressive tax on lower income households and consequently expands the income and wealth gap in the country here. And if there's anything that you've looked across many of the details that have come forward over the course of this retail earnings season, is that consumers are continuing to be extremely judicious about where they're purchasing big ticket appliances, where they're purchasing televisions even, or even the types of clothes or apparel that they are buying. And so that particularly is of note and could spell out a little bit more of how consumers across income levels are thinking about their spends, even amid this shift to services spending as well, which we'll get to in a hot second. But one of the other things that we've tracked over this most recent month here, the number of job openings that slipped, and we saw this show up in the most recent JOLTS reading. We got that at the tail end of August, and perhaps something for the Fed to pay attention to here is that it's now taking us to, I believe, the lowest level of openings since mid-2021 here. So that particularly, and I think it was, to be exact, July of 2021 and thereabouts. And so ultimately, as we think about where more of those jobs are still continuing to need to be added on, it is in a lot of the more labor intensive parts of the economy. And that showed up in today's employment situation as well, Rochelle.
It's true. And I mean, I remember, at the beginning of the year, we talked about some of these layoffs that we were seeing in tech. That's still continuing to happen. I mean, we spoke to Andy Challenger of Challenger Gray and Christmas earlier this week. And he said so far this year, employers announced plans to cut 481,900 jobs. That's a 203% jump compared to the first 7 months of last year. So we're still continuing to see this cutting of jobs. We also talked about this quiet cutting where we're also seeing people getting reassigned into other jobs as well. And that's not necessarily showing up in the jobs data, but showing some of the minimizing that we're seeing. And as we were just talking about with our guest here, a lot of these companies doing well, but it's because of some of these cost-cutting measures that are showing up in some of these job cuts, Brad.
Yeah, spot on.
And then, of course, we're And also want to shift gears because we're also seeing shrinkflation hitting brick and mortar retailers. I mean, when we heard from retailers reporting, all this week and last week as well, shrink, whether that's from mostly that we're seeing from theft or from damage, continuing to bite that bottom line there, Brad.
Yeah, I mean, and it's across retailers. You've got it at the high end, you've got it at the mid, and then also at the lower side. You heard this from Dollar General. You also heard this from Target, who many of us have perhaps had some type of shopping experience at, where you walk up to even just get some body wash. You're just trying to stay clean and hygienic at home, and you still got to wait for somebody to walk over after you wave your hand, wand your hand in front of a sensor for them to come open it up for you. That's a change in experience and customer experience there. And then even at the top end, and for Nordstrom, what we saw in a more viral video, they acknowledged that on their earnings call. And so it's really across the spectrum that shrink is impacting many of these retailers, as it was brought up on all of these conference calls in one form or another, and changing the way that they think about their inventory management, especially in store as well. But even as we're thinking about those shopping for goods out there, the shift has really been into services, Rochelle. Of course, Beyonce, Taylor Swift, Greta Gerwig's movie Barbie, they are benefiting amid a consumer spending shift. And I don't know if you got dressed up to go see Barbie movie like I did, Rochelle, but I know you actually did go see Beyonce. So you're part of that shift.
I contributed to both the Barbie economy and the Beyonce economy. I already own a lot of pink, but yes, even when I knew the Barbie movie was coming out, I made sure I had my lovely giant pink Telfar bag. I was all the way ready.
Oh, wow.
And so it's really a decision that we're seeing, that people are being very discerning about what they're spending on. They might not spend as much on other things, but they are prioritizing certain things. I was not about to give up Beyonce tickets. I was like, I'd never seen her perform. It's one of those things where it's sort of that revenge spending. It's like, look, if I'm going to spend on something, it better be something that's worth it.
Look, I agree with you. They almost got me. I almost bought some tickets to see Beyonce in Houston, because where else to see the Queen Bee than her hometown? So I don't know. But I almost was part of both the travel spending economy and then additionally the concert and kind of, just making sure that you're enjoying the experience part of the economy as well. So I almost got, but ultimately it probably would have been a great time too. It hasn't happened yet, so maybe I can go get it at some point. I don't know. It's too expensive for me. But anyway, the U.S. added 187,000 jobs in August. The unemployment rate, ticking higher to 3.8%. That's ahead of the 170,000 expected, but still shows a cooling economy. For more on August's jobs report, let's bring in Ben Laidler, who is the eToro Global Market Strategist. Ben, great to have you here with us this morning. First and foremost, just want to get kind of broad strokes, your reaction to this report.
No two words about it. I think if you're the market or the Fed, this is as close to a perfect jobs report as frankly you're ever going to get. Our third month of sub 200,000 jobs. So, a bit of a cooling, but, not too much of a cooling. Wage growth slowing a little bit month over month, participation rate going up a bit, unemployment rate going up a bit. It ticks all the boxes. I think the market will like this a lot.
But Ben, what about some of the nuances? I mean, you have some of the seasonal issues going in there, some of the, obviously, layoffs that we saw after that yellow trucking company bankruptcy, as well as what we've seen with the ongoing SAG-AFTRA strike as well. Are we going to be expecting some revisions here, you think?
Yeah, absolutely. I think, pretty big revisions. I mean, I think that's a given with this report. But again, I think the broad strokes here are very reassuring. If you're the Fed, you're worried that your underlying inflation is sort of stalling out here. You're very focused on the labor market, because this very tight labor market is what's been keeping underlying inflation pressures reasonably high. I think there's plenty to be happy about here. More people coming back into the into the labor market, wage growth slowing a little bit. I think those are the big numbers. I wouldn't be too focused too much on the overall jobs number, because to your point, I think that will be revised pretty heavily. And so,
to your point, Ben, markets are liking this report. Futures edged higher by couple, not even tenths of a percent, I will say here. But at the end of the day, if this was the Goldilocks report of the week, then what wasn't? Or what does the Fed linger on just a little bit more of all of the economic data that dropped this week?
Fed wants some reassurance, I think, right? We've come from 9% to 3% headline inflation. Core's been a bit stickier than that. That's enough for them, I think, to sort of pause this dramatic interest rate cycle that we've had. We can argue about whether we're going to get another 25 basis points or not. But basically, this is the top of the cycle. The next move will be down, but we're going to have to wait for that. And the Fed is going to wait. It doesn't want to make the mistake of the 70s. It wants to be very, very sure that underlying inflation is on track to that sort of 2% number. And key to that is the jobs market, maybe followed by the housing market. Those are the two things I think they want comfort on. And I think that's the significance of this. This is another sort of brick in that wall, a reassurance to the Fed that underlying inflation pressures are going to keep easing and get us to that 2% number, or the direction of travel to that 2% number over the next few months.
Ben, just to clarify, when you said the next move is going to be down, do you believe they cut in November?
No, I think we're on hold through to at least the first quarter of next year. But I do think the next big move for rates is going to be down. I think this debate about do we have another 25 or not is a bit of a red herring when you've come 500 basis points already. I mean, this is basically the top of the cycle. The next big move will be down, and I think the jobs market will determine when that happens.
And so, Ben, for investors then, how does this set them up for September now that they have sort of this in their pocket and we're really seeing sort of the biggest 10 tech companies really lifting the rest of the broader markets? How does this set investors up for the rest of the month?
Well, I think there was a bit of fear coming into September, right? We had a bit of a wobble in August. We were hit by a sort of triple whammy of higher bond yields, higher oil prices, and China concerns. The fact that we were only down 2%. Given that and the monster record-breaking 7-month rally we had before that, I think it's really just testament to the fundamentals that we are at the top of the interest rate cycle, that inflation's come down a lot, that earnings are troughing, that valuations are well supported. Let's not lose sight of that. That is the bull case here. And I think there's still enough investors, caught badly positioned for this rally with the fundamentals continuing to improve. I think this is a market that just keeps grinding higher.
Ben, we had on Dana Peterson of the Conference Board to help us break down some of these numbers as well, and was able to get kind of her sense about what consumers should take away from this. From your perspective, what should consumers who have been more judicious about some of their discretionary spending and yet still had to spend in kind of a higher cost environment for their needs, what should they take away from an employment situation report like this?
It's still a decent environment for them. I mean, unemployment rate at 3.7%, 96% of the workforce, has a job, and wages are still rising, and wages are rising faster than inflation. And on top of that, you've booked, if you're lucky enough to own a house, you're still sitting on big gains over the last few years. The stock market's just, had a big rally off the bottom. I completely get, the direction of travel is one where I think you do want to be a bit more judicious as a consumer. But this is still a pretty good environment for the consumer and for the U.S. economy. I mean, that third quarter GDP nowcast is nudging 6%. If that holds, that's a number you haven't seen in 40 years, right? Which in the context of us, having a debate about recession over the last sort of 6 months, I just think is absolutely astounding.
And so, Ben, as we talk about recession here, does this take some of the recession fears off the table? Can the Fed effectively potentially stick the landing if this momentum continues?
The economy is absolutely going to slow from here. But I think that soft landing is the base case. As I say, with 6% GDP nowcast, there's only one way for economic momentum to go from here, which is down. But you're slowing from a very strong level. You're doing it with a still pretty robust labor market. Consumption is 70% of the U.S. economy. I think that is overwhelmingly the sort of base case. I think the recession risks are almost off the table at this point.
All right, Ben, do stay with us. We're going to have more of you coming up just shortly. We're going to quickly take a look at shares of Lululemon this morning. The athletic apparel retailer raising its full-year guidance, boosted by a whopping 61% jump in China sales during the second quarter. Now, Lululemon's success in China is the outlier in an earnings season that saw big names like Nike and Starbucks hit hard by an economic slowdown in the country. Back with us now is Ben Laidler, eToro Global Market Strategist. So, Ben, have people then underestimated the Chinese consumer, sort of shrouded by sort of these other headlines when it comes to when people are looking at the property market, and have perhaps underestimated the China growth story for consumers?
Yes, I think a bit. This is still an economy which is going to grow 6% this year or 5% this year. The driver of that will be the consumer. The Chinese consumer are a lot more important now than it was, 5 or 6 years ago. And you're seeing that in some of the numbers. I mean, China is the biggest market for global luxury, for global autos, for global basic materials. Underestimate it at your peril. The risks, I think, are well known. The economy is absolutely growing less strongly than we thought it would, than we would like it to. But the Chinese authorities have a lot of policy flexibility here. You're seeing them begin to use it. Trimming interest rates, putting liquidity into the system. They don't want to overstimulate. They absolutely have a debt problem. They have a lot of structural headwinds. But again, this is an economy which is still, growing at levels that I think the rest of the world could only aspire to.
Ben, do you believe that what's true for Lululemon in China is also true for a Nike? Is it true for an Under Armour and Adidas? Is it as easy as saying that because they saw success there, that these other brands have to as well?
Not really. I mean, you still need to execute. Local competition is brutal. Every industry, every segment, every management team is different. But I think everybody still has a bit of a fundamental, tailwind here of a reasonably robust Chinese consumer. I think the issue has been one of expectations. We all thought it was going to be stronger. We all thought the bounce back was going to be bigger. So there's definitely been a reset to expectations. Some people built too much inventory in anticipation of that. So I think expectations has been the problem, not necessarily the pace of underlying growth.
And I mean, when you think of people wondering about discretionary income, you have to then wonder why a Lululemon is doing so well. I mean, in some instances, it's sort of a status symbol. Even my 10-year-old is asking for Lululemon, doesn't even know what the cost of a piece of clothing from Lululemon costs. But even she's on board with this, and she's Gen Alpha, not even Gen Z. How much of this is sort of like customer loyalty and branding, and really about status when it comes to Lulu?
I think it's actually huge. I mean, just look at that broader sort of luxury segment. The LVMHs, Richemonts of the world, these are some of the best performing stocks over the last couple of years. It's all about branding. It's all about pricing power. It's all about sort of aspiration. And throughout the sort of cost of living crisis and concerns about recession, they have just powered ahead. And I think that speaks an awful lot to that. I mean, this is a real two-tier economy that we have right now. And you see it everywhere. You're seeing it's been luxury and discretionary. You see it between, services and manufacturing. The sort of broad brush takeaways you've got to be a little bit careful with because you have these huge gaps in a lot of markets right now.
And I guess that's a weird or interesting, at least I should say, place that Lululemon sits is that if the consumer is saying, all right, we don't have as much to spend on luxury, then it's, okay, pan the message towards athletics and being able to make sure that you've got materials that lean more towards the active base out there. And then if it does pan more towards luxury, it's, okay, let's play up our designs that we've got. And so kind of in that messaging or in that realm here, where clearly we have a consumer that is looking across perhaps some of the more luxurious spends and saying, let's trade that down a little bit, or let's at least moderate that. Where do some of the companies who have had that messaging for so long on the luxury end need to kind of pivot at this point?
You're absolutely seeing some trading down, and you're seeing trading down from high-end luxury to maybe sort of everyday luxury, which might be where sort of Lulu sits. Consumers are absolutely picking their spots, right? They're still reasonably healthy, but they're picking their spots. You're seeing that I'm spending on treasure, on leisure, travel. I'm going to those concerts, but then when I go to the store, I'm going to the dollar store and I'm going to the grocery store, and I'm buying the own brand. So consumers are picking their spots, and as I said earlier, 96% of the U.S. workforce has a job. The issue there is not that they're going to lose their job; it's the fear that they might lose their job, and I think that's what's driving the consumer here. I mean, unemployment may go up 1% here, 1.5%, but it's really the fear that the other sort of 96% are feeling that they may lose their job, which is, I think, one of the things that's just going to grow from here and put a bit of a dampener on what so far has been an extraordinarily strong consumption environment.
And so, Ben, as you mentioned, consumers picking their spots, potentially we could be getting a new iPhone 15. Is that a spot that you think consumers will be willing to go for?
was a lot of people banking, that they hope they are, right? I mean, you've had 2 years of declining global smartphone sales. The replacement cycle has lengthened. Consumers are being, a bit more cautious about where they spend. They haven't been upgrading. If anybody can kickstart that, that smartphone cycle, it's going to be Apple. And I think there's an awful lot riding on it. Half of Apple's sales come from the iPhone. They've got 200 suppliers, around the world. U.S. mobile stocks from Verizon to AT&T to T-Mobile are basically the worst performing and cheapest stocks in the S&P 500. We've got a blockbuster ARM IPO, which is coming our way in a couple of weeks. I mean, all of those are, absolutely dependent on the health of the smartphone cycle. And as I say, if anybody can give it a jolt in the arm in a couple of weeks, it's going to be Apple.
Can smartphones be as successful as stretchy pants then in China?
I mean, we'll see, right? I'm not the expert on stretchy pants, but fingers crossed.
All right. I've got a little bit of elastic in mind today, so I guess I am at least the resident expert for at least this conversation. Ben, stay with us. We've got much more to discuss here. Particularly, we got to go to the IPO market. The 2021 IPO boom was a field day for retail investors and the companies which raised over $140 billion in proceeds. But as markets lulled in 2022, so did the market for listings. 2023 could mean a bounce back off of 2022, at least. According to Renaissance Capital, filing activity is up almost 27% from last year after Kava's big IPO and a volatile start for Vietnamese EV maker VinFast. Investors looking to SoftBank's ARM as the future of the market here. The chip designer is reportedly expected to start trading September 14th. If it goes well, it could open the door for other highly anticipated IPOs. You're taking a look at some of those logos on your screen. We're bringing back in Ben Laidler, eToro Global Market Strategist. One of those logos I don't expect to come public, but it could happen, SpaceX, because Elon Musk has been very vocal about what he thinks about his companies being public. All that put aside, ARM could potentially open the door here. Ben, what do you expect?
Yeah, I think so. I mean, they're testing the waters, right? I mean, to your graph, IPO activity is basically 90% down since that 2021, boom. But just as we've seen sort of investor appetite improve this year, so we're now beginning to see company appetite sort of improving. So this is the big test, right? ARM, Birkenstock, Instacart. These are big IPOs. They're going to test, I think, investor appetite. So we'll see, right? Every IPO is different. We'll see what the pricing is. We'll see what the we'll see the story they sell to in investors. But I think that that's the next step of I think of this rally, right? It broadens out to other sectors. It broadens out to other constituencies. The other point I would just make, though, this, however big the IPO pickup is over the next couple of months, is still a fraction of 2021. The number of listed stocks in the US is still down 40% off its highs. I think this is a supply and demand issue. There's a relative lack of supply for US stock and a lot of demand. And I think that's one reason why the US has the highest valuation multiples in the world.
So Ben, given where we were with the heyday of IPOs, what do you think investors are going to be looking for specifically as they look at these IPOs that are launching and trying not to get caught up in the fear of missing out?
I think they're going to want to see real dollars and cents, real cash flows. We saw in 2021, at the top of the cycle, a lot of companies on a sort of hope and a dream and no cash flow coming to market. I think a lot of people have sort of learned their lessons from that. So I think we're going to be looking at dollars and cents, at least at this early stage of the IPO market sort of coming back. So I think it's going to be it's going to be very fundamental, down in the weeds. And again, this is very, very early days.
And it's clear they are looking for dollars and cents. I mean, if we're looking at some of the other data points here from Renaissance Capital, of the filings that have taken place, 118 of which there have been, 88 were industrial IPOs that were filed for this year. That's the most of any sector here. And so considering where the raise perhaps differentiates from the total volume that's representative of sectors here, where is it clear that investors might have to be holding out for some of the path to profitability? And in which sectors is it kind of the typical ones, if you would, in technology?
So I think that's a little bit of the test here, right? I mean, you've got Birkenstock on the one hand, that's a brand that's been around for a very, very long time.
Heavy technology there, Ben. Yeah.
Well, right, and again, so within technology, again, ARM is probably a sensible place to start, right? It was listed for a very long time. It's a well-known story. They absolutely dominate the smartphone market. They have a 99% share of the smartphone market, and they're now getting into sort of AI, driverless cars, cloud. I can see, again, price dependent. That is an interesting story. Instacart, the numbers I've seen, they seem to be making money, now as well. So I think, within that sort of tech ecosystem, these are, some of the stronger, more cash flow generative, better known companies. So it makes sense that this is the sort of place to start, but it's all dependent on, the valuations, and we'll see how forgiving sort of markets are. As I said before, I think the path of least resistance is sort of up for markets, but I think there's still, a certain amount of nervousness out there, and investors are still going to trade reasonably carefully.
I mean, especially when you look at a company like Instacart, when you look at the competitive moat around them, I mean, you already have Amazon, you have Grubhub already sort of filling some of these things. And especially as customers are looking to, especially on things like groceries and deliveries, trying to cut back on their spending. How well positioned do you think some of these consumer focused products like an Instacart are going to fare versus, say, an ARM, for example?
Absolutely. I mean, ARM has 99% of the smartphone market, so they clearly have a bigger moat than Instacart does. But I think the U.S. consumer's in very good shape. And from what I know about Instacart, I mean, the business model has changed. I mean, most of the revenue is not coming out of what they charge for delivering your groceries. It's coming from advertising and other revenue streams. So again, to the extent that they are successful at diversifying those revenue streams, I think it becomes a stronger business with a bigger moat around it. But I think, those are absolutely the questions to ask in an environment where, at the margin, the consumer is absolutely getting less strong here.
Ben, I think you made a great point in that it's really a bunch of household names at this time, or at least in this environment, that need to be the ones or could be the ones that have to be the standard bearers for opening up the IPO markets once again here. I mean, I love my Birkenstocks as much as the next person, but I do have a question for you, just regardless or regarding whether or not we should hold our breath for a SpaceX IPO.
The short answer is no. I'm sort of relieved. Given we've done stretchy pants, you weren't going to ask me about my shoe wear. But no, I would say no. He doesn't seem to need the money, and I'm not sure why he would put us all through the pain of bringing SpaceX to market.
Certainly already has enough on his plate, for sure. Vicky, thank you for joining us this morning. Ben Laidler, eToro Global Market Strategist. Great having you. Have a wonderful weekend. All right, coming up, there's Yahoo Finance's tech editor Slack Jawed and spinning like a pinwheel. Does Dan Howley make it home? Does he even make it out of the town square? Find out on Yahoo Finance next. It's time for the opening bell on Wall Street. Let's see how markets are faring at the morning. We're seeing the Dow there up there more than 220 points. The S&P also buoyed there, up 0.7% or 31 points. And the tech-heavy Nasdaq there also up by about 112 points or 0.8% after that jobs number, buoying them that they might perhaps get a little less action from the Fed going forward. Well, let's get over to Brad Smith at the Yahoo Finance Interactive. Brad, what else are you seeing?
Hey, Rochelle. Yeah, taking a look at some of the major averages this morning. Let's toggle on over to the Dow Jones Industrial Average, up 0.7%. Nasdaq Composite, 0.7% in gains there, and the S&P 500 about the same on a percentage basis. Let's take a look at some of the sector activity out of the gate this morning. You've got green across the screen for some of the 11 S&P 500 sectors here, 11 of 11 in positive territory. So we're batting 1,000 as of right now. We'll see if we can hold on to that. We're up by about 1.5% on that leading sector in energy. You're also seeing materials moving higher by about 1% there. So all in all, looking pretty good there. Let's take a look over at the Nasdaq Composite tech-heavy average. Only a few red spots, a couple pimples here and there. Let's take a look at where they lay right now. We're going to get into Walgreens Boots Alliance later on. That's going to be in a different chart. But Warner Brothers Discovery, since I got them pulled up, they're pulling up the caboose here on the day for the Nasdaq 100. That's down by about 6.4%. Also got a few more red areas entering into the fray, but many of them kind of coming in the form of some of those streaming services here. So we'll kind of keep a close eye on that, or at least some of the former linear TV plays. Then additionally, taking a look at the Dow components here on the day. Again, just a few down spots. Disney, that's down 3.5%, kind of continues what we were talking about in some of the larger networks or production houses or streaming plays, however you want to encapsulate it. Take a look at Disney, that's down 3.5%. We'll have a little bit more on that. Since I mentioned kind of all of these moves in streaming that we are tracking, let's just put that on a heat map for you for a hot second here as we're taking a look at some of those declines. This is some of them, but ultimately there you're kind of seeing more encapsulated those moves that we were seeing in Charter, Warner Brothers Discovery, Disney, and Comcast here. So we'll have a little bit more on that just a little bit later on. But lastly here, just want to give you one more look at what we were seeing in the world of, here we go, some of the China stocks, and this coming off of the report that we had seen from Lululemon that they had seen some strength in China. Lots of the movement out of the Golden Dragon components here today, moving higher here. And then just lastly, perhaps we can just toggle over to a brief look at some of those trending stocks, because Lululemon should certainly be up on that board as one of our top trending tickers. It's the second highest top trending ticker on the day, up 2% at the gate on the back of its earnings report. Rochelle?
All right, thanks, Brad. Well, taking a look at Walgreens stock under pressure this morning after the CEO, Rosalind Brewer, steps down. The board has appointed Ginger Graham as the company's interim CEO. Here to talk more about Walgreens' issues they're facing and their future, Yahoo Finance reporter Anjali Kemlani. Hey, Anj.
Hey, Rochelle, that's right. Rosalind Brewer stepping down this morning in a seemingly abrupt move for the company just a few weeks after they already lost their recent CEO. So now two leadership roles are empty and they're searching to fill those. In a statement this morning, the company said that it was a mutual agreement for Roz to step down with the board. She will, however, advise the company while they conduct their search for a permanent CEO. She's no stranger to leadership roles. We've seen her in the past at Starbucks as a chief operating officer and president of Sam's Club, but this has been the shortest stint so far in a leadership role. She joined Walgreens in the middle of the pandemic in 2021 and has only just after 2.5 years stepped down. In a LinkedIn note this morning, she did say it was the hardest note she would have to write, but no clarifications, no clarity as of right now as to what caused this sudden departure.
Yeah, Anjali, this a huge move here that we're seeing announced by Walgreens, especially considering the fact that women in CEO roles, and then even more so black women in CEO roles, very small percentage of the overall makeup in the Fortune 500 and S&P 500 as well. We've also seen today that the FTC is following Amgen to buy Horizon Therapeutics. Can you tell us what that means for the pharmaceutical industry?
Yeah, that's going to be a quick move forward. The FTC and Amgen coming to an agreement on the decision to close that deal for the end of this year, fourth quarter of 2023. And Amgen has said in a statement today that, the agreements or the issues that they had with the FTC will now be put to rest. The FTC filing to challenge that acquisition on grounds that they suspected that Amgen could really monopolize the market and stifle competitors to some of the products in Horizon's pipeline. So as it stands right now, this just clears the pathway and they can continue moving forward for that deal closure at the end of the year.
All right, Anjali Kamlani, Yahoo Finance's own. Thanks so much for tracking those stories, breaking them down for us, Anj. Appreciate it. Also here this morning, Dell is soaring after crushing Wall Street's estimates for the fiscal second quarter and issuing an upbeat outlook. CEO Jeff Clarke saying demand for Dell's proprietary software storage has risen over the last 8 quarters, and we're seeing shares move higher by about 19.5% right now, Rochelle.
Indeed. I mean, I know that when we've been talking about a lot of these companies, we've been more focused on the sort of the PC slowdown that we've been seeing there. But as we've mentioned here, with some of these data centers and cloud, still seeing some positive growth there. So that's something to definitely keep in mind as well. Also want to take a look at 23andMe stock that's rocketing higher after the FDA cleared the company to report an additional 41 genetic variants that increase the risk for breast, ovarian, prostate and pancreatic cancer. Now, this marks the company's 4th FDA clearance for genetic cancer risk. I mean, clearly this is good news. I mean, a lot of people were wondering what was going to be sort of the next evolution that happened with 23andMe. When they first started, it was about, finding out your ancestry and things like that. Then it became more into the health space. So this really is a positive move that we're seeing here. So glad to see that momentum. And obviously, the more informed we could be about our health, the better.
Yeah, absolutely. I mean, for many of us who had used 23andMe to try and figure out what our ancestry was, of course, there's kind of a limited amount of engagements or interactions that you could have with the same consumer. So how can you create more of that? Well, for 23andMe, it's certainly looking towards more of the health applications there. 23andMe was also granted an FDA predetermined change control plan, allowing the company to update their report with additional variants that you had mentioned, provided they meet the same analytical and clinical requirements demonstrated in the current clearance that they did have with regard to the variants for BRCA1, BRCA2, known to be associated with higher risk for breast, ovarian, prostate, and pancreatic cancer. There you're taking a look today at the move, up by about 4%. Well, coming up.
And it really just...
Oh, yeah. Sorry. Go ahead, Rochelle.
I was just going to say, it really does speak to this move that we're seeing in also hyper-personalized healthcare, because, for certain specific risks that could be, hereditary for you or for your family members, this really does open that up. And we've seen that sort of hyper-personalization, and it'll be interesting to see how that develops from here. So nice move here from 23andMe.
Absolutely. We'll continue to keep close eye on the shares here today with that price action. Coming up, Seoul has more Starbucks stores than any city in the world, but Dan Halley isn't looking for a brown sugar shaken espresso. Find out why he's there on Yahoo Finances next.
The August jobs report beat expectations, and we've got some historical analysis from you-know-who, Yahoo Finance's Jared Blickery, or Dr. J, joining us with the breakdown. Hey, Jared.
Thank you, Rochelle. Well, here's an interesting chart I dreamed up here. This looks at the SPY, and that's the S&P 500 ETF, cumulative net returns on employment situations days. So if you look at the close on the Thursday before and then the close on the Friday, and you add all those and subtract if there's any losses over time, this is what you get, this blue line. Now, in gray in the background is the actual performance of SPY, or the S&P 500. What we can see here is they largely track each other. Sometimes the employment situation report has been a little early and maybe predicted a downturn, you might say, but it's also been late. So kind of a mixed bag like there. I'd say on this upswing here, the indicator was a little bit late. But what I'm interested in is what's going on at the right-hand edge of the chart here. And we can see, despite the market has largely been going up here, we do see this downtrend in the indicator. That's actually going to tick up a little bit today. But for the most part, I think we would want to see these two in unison. What I'm really interested in is seeing how SPY reacts also to the CPI reports. That's actually an even tighter correlation. And so my thinking is when I see a couple of big down moves on one of these two reports, or both of them, the NFP and CPI, that's probably it. That's probably it for the rally for a while. I don't think we're there yet. So just something to think of for the coming weeks and months, guys.
All right, Yahoo Finance's own Jared Blickery there. Wait, while we have you, Jared, as we kick off the first trading day of September, is it time to rethink your portfolio?
Let's take a look at the VIX, because lots of different seasonality studies on September are showing that not only does the VIX tend to spike up, equities tend to sell off. But something interesting is happening this year, and in particular with the VIX over the last 6 days. We've seen this really big downswing in VIX. That is a risk-on signal. It means that there's less volatility, less expectations of volatility in the market. And we've come all the way down to the lows of the year there. That's only a 3-month chart, but that is the lows of the year. So what happens in September and October? That's back to school. That is prime time crash season, because a lot of big institutional players do not like to establish new positions or rollover positions in the summer. So it's just kind of understood that in September, you get a new narrative, you have a massive repricing a lot of times. Sometimes that spells trouble for the markets. And I've cooked up some of these statistics here to show what happens on an historical basis. There's our chart from before. Here's VIX and what happens to VIX. Usually the seasonality is, here we are just coming out of August. You can see September a little bit higher, October a little bit higher. Then we get some relief in November, and then Santa Claus rally in December. But we have to get through these 2 months first. So I said the year is a little bit different this year. Here is showing S&P performance by month. The purple line is September. You can see going back to 1960, if you invested $1,000, it would only be worth about $600 now. So September, not usually good. But this year, we had something interesting happen. We had a huge rally into the end of July, and then we had a drop off in August. When I take a look at these years, we have overwhelmingly bullish results for the end of the year. September, October green, November, December, all of those green, with the also pretty high percentage hit rates, except for October, which is only about 64%. That's 7 out of 11. So what should we expect for September? Well, it's usually a bad month for equities, but because of the huge performance that we had earlier in this year, it might not be that bad. Hopefully we'd be able to skate by with a few hiccups into year end. We know there's going to be a lot of focus on the Fed and all these reports. So I think the one thing that could interrupt all of this goes back to my original chart here. I'm going to be looking at the market reaction like this. On days like this, and also on the CPI days, for those big downswings. And hey, we're not there yet, so that's cause for optimism.
All right. Thanks so much, Jared. We'll be keeping a close eye on that, as we know you will as well. Appreciate it. Well, key issues between Hollywood writers and studios still linger as the strike heads into its 5th month. But media mogul Barry Diller warning of catastrophic consequences should Hollywood studios continue to partner with streaming giants like Netflix, even calling it the architect of the strike on Kara Swisher's podcast. So who's poised to take on Netflix as the strike continues? Mark Douglas, Mountain CEO, joins us now. Mark, great to have you here with us in studio. Yeah. I mean, these comments are sending shockwaves right now through the equity price action of some of the largest streamers and some of them former linear powerhouses in television as well. I mean, what do you make of the comments here? And could we really see some type of new negotiation process where the different studios are trying to keep Netflix out of the conversation?
Well, if you look at the economics on it, I'm not sure how that quite works. So, look at Disney, for example. They did about $10 billion in studio revenue last year. Netflix is 3 times that just by themselves. So they're the size of like a couple of major studios combined. So I don't know how you take an industry that seems to be largely striking over streaming and try to separate it out, and that's, like the writers and the actors that kind of think that makes sense. I think the other thing you see from the comments is that whenever these studios are in trouble, it's like the finance team takes over, and it just doesn't make sense. I was talking to a friend last night. I was like, if we were in a restaurant, I'm like, if this restaurant had like fewer people in it, you don't call your accountant.
No.
You call the chef. So I think these studios have to meet consumers where they are. The consumer sees no difference. Like Oppenheimer, 3 hours. I want to see it at home. I don't want to go in the theater. I'm actually willing to pay more. This is also not new. All this talk was on DVDs, 20, 30 years ago. Every time there's a new technology, it's like everyone's up in arms over it. And so bottom line, focus on the consumer. Bring the content, consumers will bring the dollars, and we can go forward with everyone entertained and the industry in a healthy state.
And Mark, Rochelle here.
Yeah.
As we look at Netflix, obviously holding the crown here, but then when you think of who is the next best contender, because Amazon has an interesting market there, because it's usually people subscribing for Amazon, not necessarily for the streaming content. It's because they've already got it for the shopping or something else.
Yeah.
Who would be the next closest contender to a Netflix?
Well, I think a lot of people are thinking maybe Apple, mainly because Apple has essentially the dollars to lead a consolidation. I'm not sure that actually makes sense for Apple, because Apple's more focused on a bundle. Remember, Apple not only has Apple TV, they have Apple Music, Apple News, Apple Games. And so what Apple wants is they want $20 a month from every iPhone user in the world. And they don't have to create content for music. They don't have to create content for games or for news. But they are clearly positioned, if there's going to be a consolidation, they are the ones that can lead it. Whether that makes sense for Apple as a company, I'm not so sure. But they're in the best next position. I agree with you. I don't think Amazon, that there's a lot of reasons there for Amazon to lead a consolidation of a bunch of these studios.
You were talking about Oppenheimer a moment ago.
Yeah.
That's a film that was already in the can. Promotion had already been done.
Yeah.
So by when now do many of the talks for strikes and negotiations need to be netted out by?
I think so. So until the actors strike, you could still film even though the writers were on strike. And
Sure.
so I think when the actors went on strike, that literally has shut things down. I mean, if you look back on COVID, I mean, they went quite a while without new content and still were able to survive that. So, you're looking, I think, Q1 and Q2 before consumers are affected in terms of they can't get the content they want. And there are a lot of big shows out now. You have Billions out. You have new seasons on all these streamers. So I think the fall and the winter is taken care of. By the early next year, it's really going to start to affect the funnel of content that comes out. It's going to start to become a big problem.
Yeah.
And Mark, who do you think is most at risk in terms of losing brand loyalty? Obviously, you've got consumers trying to pinch some pennies here. There might be 1 or 2 streaming services that they're going to hold on to, but then when you factor in things like live sports coming into the mix, who do you think is going to have the best brand loyalty out of the streamers?
Well, it's always Netflix, and the reason why is, without a doubt, the reason why is Netflix is where you go when you're not looking for your favorite show. I think most people I know, and I'd say this for myself, when I turn on my TV, the first thing I do is see what's on Netflix. So they're positioned very well. Second thing I want is sports content, which comes from Hulu, YouTube TV. In the third slot, I think Disney, everyone thought they had that locked up with Disney Plus, but Disney has stumbled quite a bit. Their Star Wars content is lagging. So I think it's kind of a toss-up, and a lot of people, their behavior is, well, I'll binge on Disney for 3 months, then I'll binge on Showtime for 3 months, I'll binge on Max. And so that third slot, I think, is really where a lot of the competition is. The first slot, I mean, Netflix just has it on lock. They have muscle memory, meaning you turn on your TV and you just go for Netflix. And so I think that's going to be hard for anyone to overcome.
Well, for a lot of sports fans out there, they tend to have the second spot that they go to where their team is playing.
Right.
And I mean, as we're beginning NFL season, of course, there's a different type of football that's capturing attention. Is Messi is now playing in the MLS, and Apple has those rights for broadcasting and for streaming. So is the Messi effect taking hold? Is that as effective as Apple was hoping and intended it to be in this battle for some of these streaming rights for sports right now?
Yeah, so the way I think to always think of Apple is they don't want the fee for Apple Plus, they want the fee for the Apple bundle. So they're always going to try to put in enough content that you'll just go for the whole bundle. You'll switch from Spotify to Apple Music if you're a Spotify user. And so I think, they've gone after sports. Messi made a lot of sense for them. He's like taken over. I live in Miami. He's taken over. You see posters from everywhere in Miami. So people really love that. But I don't think you'll see Apple like kind of keep going further, because their bar is to stay on track for that $19.99 a month bundle for all the services. And everyone has to remember, for 3 of those, they have no production costs whatsoever. Right? They're just streaming music. They're not making the music. So it's particularly profitable for them.
And Mark, as a football fan, if I was going to sign up for that Apple streaming service, it would be maybe just to watch Messi play, but chances are afterwards I probably wouldn't use the service anymore. I probably would disconnect it. But I do want to ask you, in terms of losing magic, I have to ask you about Disney Plus, and how do you see their streaming strength going forward?
Well, I mean, they have the assets. The question is do they want to invest in them? I mean, they've kind of actually said they're de-emphasizing Star Wars a bit. Obviously, they have Marvel Studios. I think Disney as a company has a lot of strength. They have all the sports. I mean, if you own ESPN, I mean, you just, to some extent, you almost own sports. They have all the children's programming, family programming, and for some reason, they just seem to not be able to bundle it together in a way that they keep growing the subscribers. I think they'll figure it out. Bob Iger is obviously a strong leader. And Disney, if you look at their revenue, it's gone up consistently over the last 10 years. It's profitability where they've stumbled. I mean, in 2019, they were doing something like $12 billion in profits, and now they're doing $3 billion. Even though their revenue is higher. So I think for Disney, it's like do 10% more with 10% less, fix the profits, and just keep giving consumers what they want. That's the bottom line.
We got to go. If there's one name that you think wins out the advertising play here now with all these streaming services adding in that tier, who is it?
I think over the long term, it's definitely Netflix. But in the short term, I think NBC is actually a lot stronger than most people give them credit for.
All right.
All right, thanks so much. Mark Douglas there, Mountain CEO, thank you for joining us this morning.
Thank you.
Now, many are called, few are chosen. Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. We'll find out when Yahoo Finance is next.
The growth of the legal cannabis industry has been a story these last few years. The Department of Health and Human Services has been conducting a review into cannabis under a directive from President Biden. This week, it sent its findings to the DEA, the health agency, recommending the drug be moved from Schedule I to Schedule 1 to Schedule 3. But the DEA will make the final decision, one which will shake up the space forever.
Curaleaf is a big player in this world. The company has operations in 21 U.S. states and 8 European countries. Stay tuned. At 11 a.m., we're talking with the CEO, Matt Darin, on all of that and more. And ahead, are you in the mood for some milky Korean soft serve? Dan Halley isn't going to say no to a local delicacy. But what else is he getting his teeth into? Tune in to Yahoo Finances next. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. We're about 30 minutes into the trading day and the first one of September. Let's take a look at how stocks are moving right now. They are higher to start September following the August jobs report, which topped expectations at 187,000, but still shows a cooling economy. Importantly, wage growth is also cooling down, rising just 4.3%, setting the Fed up for a widely expected September pause.
And taking a look at individual names, XPeng is on the rise this morning as Chinese electric vehicle deliveries hit a record high for any month when combining Li, NIO, and XPeng's results. XPeng delivered over 13,000 smart EVs in August, an increase of 24% month over month and 43% compared to the year prior.
We're also watching Nutanix pop this morning after topping analyst expectations for its revenue in its fourth quarter and issuing strong guidance. The company recently introduced a GPT in a box, which allows users to run AI models while controlling their data.
And we're keeping our eyes on Broadcom, which doesn't seem to be benefiting as much from the AI hype as its competitors. The chipmaker reported results just above expectations and issued inline guidance, which wasn't enough for investors who are used to Nvidia blowing their estimates out of the water. Still, it's expecting AI revenue of $7 billion next fiscal year from around $3.8 billion this year. Well, September, the start of a new month and most likely the same old Fed. Last week, Chair Jay Powell said the central bank is, quote, prepared to raise rates further as it continues to fight to bring inflation back to its 2% target. However, our next guest believes Jay Powell is now more focused on containing inflation than preventing a recession. Let's bring him in. That's Jim Caron, Morgan Stanley Investment Management Chief Investment Officer and Portfolio Solutions Group Manager. Thank you for joining us this morning. So what does this then, this focus, or this hyper-focus on that 2% target, what does that mean then for the economy and some of the numbers that we're now seeing with the jobs data?
Well, I think it's really a question of how seriously do we take the Fed on that 2% target. Now, clearly that's boilerplate language for them. That's their target. They're not going to stray from that. They're not going to communicate anything different. The markets, however, I think see it somewhat differently, which is that if the Fed were to actually really try to bring inflation down to that 2% target, that they would do probably more harm than good in the overall economy. So I think as long as we approach 2%, let's say we get to 3 or slightly under 3% inflation, and that creates enough stabilization and that, things are cooling, inflation's cooling down. And really what's the most important is that inflation expectations are no longer driving higher. So therefore, inflation can stay anchored, and that's the key word, anchored at lower levels. I think the Fed's going to be happy. Do they actually have to get to 2% right away in order to do that? No. But I do think that the Fed is in a position right now to sacrifice some growth and to allow things to cool. We could see that in today's unemployment report, and labor markets may weaken even further. I think they're okay with that as long as it anchors longer-term inflation expectations.
Jim, that starts to get to my question, which was, do we need to see continued slippage or cooling in the employment situation in order for the Fed to get to that inflationary target?
Yeah, look, I mean, it's a good question because that's really the hard truth, and it's what the Fed has been very, very clear about. Look, the Fed has a 4.1% unemployment rate target by the end of this year. Now, that sounded kind of crazy up until recently when we got today's number. 3.8% puts us in the ballpark. Look, I think that the unemployment rate needs to get up towards the 4.5% level, which is very close to what the Fed's ultimate target is. Also, in order to get inflation anchored, and that's the key phrase there. In order to get inflation anchored, we need to see the unemployment rate continue to rise, further softening of the labor market, some cooling in wages. And this is all about the Phillips curve, right? The unemployment rate versus inflation, that inverse relationship between the two, which is what the Fed's primary MO is, effectively, is they need to see the unemployment rate rise to slow wages in order to contain inflation. And I think that's the script.
And Jim, we heard the Fed say, we heard from Powell saying they're navigating by the stars under cloudy skies. As colorful as that language is, for investors who are trying to say, okay, well, what do I do in this sort of environment when they're saying, obviously, 1 month of data does not a decision make? How should investors be positioning themselves right now?
Yeah, so that's a great question because, really what it tells us is that it's hard to determine. When Powell said navigating by the stars under cloudy skies, what he's really saying is that he's not sure himself. The Fed is not sure where the policy rate ought to be in order to stabilize inflation. It could be higher. Maybe it's just at the right level. What that tells us as investors is that the outcome of investments has 2 fat tails on either side, meaning that it could be that conditions are fine right now and that we're going to get a slowing of inflation and the Fed doesn't have to hike rates, which the equity markets, as we see today, view that as a very, very positive sign. It could also mean, though, that what if inflation doesn't remain anchored and that the Fed has to go more, then they will be prepared to hike even more, and that could be very, very negative. So what it tells an investor is that you really need to have a diversified portfolio. The way we see it is that fixed income looks attractive to us, but primarily in the front end. We think about an average of 3 years of duration makes sense in a fixed income for an average fixed income exposure in terms of duration. In terms of equities, look, we like the value sectors more than we like the growth sectors, but we also respect what growth can actually do. Growth has been very, very strong this year. It may set back and value may take over. So what we still like to look at is these value sector companies, which are trading on average with about a 15 PE multiple, so valuations are not crazy high, that actually say that if we have a softer or a mild recession, softer landing, mild recession scenario, that the value sector is actually poised to do very, very well in that type of an environment. So we think having good value equities and some high quality fixed income, but towards the front end of the curve.
Jim, a lot of people, and really getting into what you were mentioning there and kind of laying out in terms of a strategic perspective, are wondering what a slowing economy, but especially a slowing employment situation might mean for their portfolio. What are some of the early kind of pivots that they can make?
Yeah, so good point there, and I like the word slowing, not collapsing, right? So it's slowing, not collapsing. So I think some of the pivots that people can start to look towards are more of these larger company, more value sector, like the industrial sector, materials. These typically have lower PEs. I think the U.S. is in a manufacturing renaissance that's going to be with us over the next several years. So to the extent that you get a higher unemployment rate, we do get a slowing of the economy and perhaps a mild recession, we should get a setback in equity prices, right? That there should be a correction in here somewhere. And what we prefer doing is buying on weakness as opposed to selling on strength. So we are not in the camp that the markets are just going to, equity markets are just going to collapse and you have to, sell strength and reposition. We're more in the camp that we want to have a very well-balanced portfolio, and we prefer to buy weakness, and primarily in these larger company value sectors, because they have higher pricing power. So as margins are getting squeezed, they can actually survive better. Ultimately, eventually, what I'd like to also do is then start to move in the small cap areas, which are a higher beta sector, so that if we do have a slowing of the economy and it's a mild recession, which, by the way, I think would be healthy if we have that sooner rather than later. If we have it later, it's a harder fall. That I would rather buy that weakness into a sooner recession versus a later one.
Jim Caron, who is the Morgan Stanley Investment Management Chief Investment Officer and Portfolio Solutions Group Manager. Thank you so much for joining us here today. We appreciate it.
Thank you.
Absolutely. Coming up, there's Yahoo Finance's tech editor, slack-jawed and spinning like a pinwheel. Does Dan Halley make it home, though? That's the big question. And does he even make it out of the town square? Find out. And Yahoo Finance is next. It's no surprise the construction sector isn't dulling out. 22,000 jobs were added in August, in line with the monthly average over the last year. Yahoo Finance's Danny Romero joins us with the breakdown here. Hey, Danny.
Hey, Brad. Well, good news if you want to become a construction worker, there's jobs out there for you. Let's get back to that breakdown. Jobs in construction of buildings clocked in at 4,200 jobs. Residential building construction gained 2,400 jobs. And then that signals that there's a pretty good pickup when it comes to projects on the residential side, new homes. Non-residential building construction also gained 1,800 jobs. So that means there are more jobs to build our hospitals, our schools. So definitely a good sign. Heavy and civil engineering construction, those are jobs to build our highways, streets, roads, dams, water supply. That gained about over 7,000 jobs in August. So that sector really benefited from the Infrastructure Act, which the White House said in a report that 37,000 projects were awarded through that bill. So moving over to the specialty trade contractors, that sector added over 11,000 jobs. Residential specialty trade, that lost about 1,000 jobs there, but that's not something to be too alarmed about. That's usually a seasonal thing. Construction coincides with traditional home buying season, so that could be something that we're seeing there. And then non-residential specialty trade contractors gained more than 12,000 jobs, another sector that benefited from that Infrastructure Act.
Thanks, Danny. Hopefully we see that translate into more housing inventory at some point down the line as well. Danny Romero, thanks so much. Well, the August jobs report came in a little higher than expectations at 187,000, a little more than the 170,000 expected, but still shows signs of cooling in the hot labor market. The unemployment rate also ticked up, now at 3.8%. Investors are hoping the results mean the Fed will hold rates steady. Joining us now on this is Yahoo Finance reporter Jennifer Schonberger. Hey, Jennifer.
Thanks, Rochelle. For more insight on this morning's jobs report, I want to bring into the program Acting Labor Secretary Julie Su. Secretary Su, thank you so much for joining me. It's great to see you.
You too.
The labor force participation rate bumped up last month. It's now at the highest level since pre-pandemic, February 2020. At the same time, we saw the unemployment rate go up, more people coming into the workforce, more people looking for work. Your take?
That's exactly right, and those two things are connected. So more people coming to the labor force, it's a sign of optimism, right? That recovery has happened faster than anybody predicted after the pandemic, and that did result in a slight increase in the unemployment rate, but it still remains under 4%, which is now the longest stretch since the 1960s. So very much a sign of strong, stable growth that we would want in a strong economy.
Even though we saw some cooling on that top line number, still a very tight job market, to your point. But given that we're seeing now fewer job openings, still quite a lot, right, but still fewer, and now more people entering the labor force, what's the prospect that the power will shift from the worker to the employer maybe come next year?
Yeah, so the president's economic policy, right, his Investing in America agenda has always been about not just addressing our roads and bridges and need for clean energy and the manufacturing boom, but creating more good jobs in all communities across the country. And we're seeing continued job growth in exactly that way. What we now are really focused on, especially here at the Department of Labor, is making sure that everybody has access to those jobs, that we're creating equitable pathways so that everybody can share in the prosperity that continues to characterize this economy under Bidenomics.
I want to ask you about the United Auto Workers Union talks right now. They have threatened to strike if they're not able to reach a deal with the major automakers. President Biden has expressed concern about a potential strike. What are you hearing now from both parties?
Right, so to take one step back on that, right, we've talked about, this tight labor market and workers having more power. One of the features of that is that unions also have more power to make demands at the bargaining table. And we've seen the positive effects of that over President Biden's tenure. Right? We've seen increases in wages in bargaining agreements. We've seen addressing other issues, right? The Teamsters and UPS reached an agreement that also has air conditioning in trucks. Like, we're thinking about what makes a good job in multiple different ways. The president believes, as I do, in the collective bargaining process. And part of that is allowing the parties to do what they need to do, respecting that process, and encouraging them to stay at the table, which we want to see. But that is certainly what continues to happen, at least for now, in those UAW talks.
Really quick, you think we can avoid a strike?
I don't want to predict that, but I think anytime the parties are at the table and talking to each other, that's a good thing.
Speaking of unions, the Treasury put out a brand new white paper this week showing that unions help the middle class. Union workers can see wages of 10 to 15% higher, and that can actually spill over to help non-union workers. Though given that union membership is so low right now, what kind of impact can we expect to see? And if we had higher union membership, what type of a different job picture would we see in terms of both job creation and wage growth, which is already robust now?
Yeah, we're also seeing the highest level of support for unions in public opinion polls since 1965. So I also think that is not accidental, right? This is very much a part of when you have a president who is saying that we want an economy where workers get their fair share. We want the jobs we create as much as possible to be good union jobs because of those benefits, because of job security, because of wage growth, because of other kinds of benefits in union jobs that also have an upward effect on working conditions elsewhere, that those are all very, very positive things and very much a part of how the president sees a good, strong economy.
You and I have talked about closing the gender pay gap and women's equal pay. How do you think unions can play into perhaps closing that pay gap?
So studies show that unions have a positive effect on closing both the racial and the gender wage gaps. That's another reason why the more we can create good union jobs in all communities across the country, this is going to be a positive thing. Now, the Department of Labor is really focused on that access to those jobs, right? If you look at jobs like construction, those jobs still largely remain male-dominated. And so we are investing across the country in programs that are creating pathways for women. Like in Chicago, we are investing in a program called Women Building Infrastructure, Tradeswomen Building Infrastructure. And that's a way that we're going to expand more equitable access to job security and the kind of breathing room for families that we want.
Is there anything that the Labor Department can do specifically when it comes to writing rules to offer more transparency to help close the pay gap? Is there a way to prevent discrimination based on gender? Is there a way to mandate perhaps that women that have commensurate experience with men in the same position who are performing are entitled to and should get equal pay to their male counterpart?
So this is where it's really important for us to think about, everything we've talked about is about building the high road to the middle class, right? Good jobs, access to those good jobs in all communities. In order to do that, we also have to combat the low road, meaning we have to enforce the law to make sure that everybody's playing by the same set of rules. And that means that women should be paid in the workplace if there's a disparity in pay that is illegal, there should be enforcement of that. But the other piece of it, and we've talked about this before, is addressing occupational segregation, making sure that in these certain jobs, like I mentioned, construction, where women tend to be underrepresented, but they're good jobs, pathways to the middle class, that we open up those paths to women too.
Well, Secretary, I know this is an issue that you and I have talked about before, and I hope we can continue talking about it in the future. Thank you so much for your insight. I so appreciate it.
Thank you so much. Thank you.
That's Acting Labor Secretary Julie Su. You're watching Yahoo Finance Live. We'll be right back.
Overall, it appears that a majority of Americans approve of labor unions. And according to a new Gallup poll, 67% side with television and film actors amid the ongoing Hollywood strikes, with less than a quarter siding with the studios. Now, SAG-AFTRA members have been on strike since July, and many are finding new ways to make money. Video message site Cameo has seen more than 2,500 celebrities start or reactivate their accounts since the strike began. On Thursday, Cameo CEO Stephen Galanis joined Yahoo Finance in the afternoon, where he spoke about how the strike is impacting their growth and pushing more celebs to their business. Take a listen.
In the last 48 days since the SAG strike started, we've seen over 2,500 talent join or reactivate on Cameo. This is 180% month-to-date increase from where we would have been before the strike. And it's really the best time that we've had from a talent onboarding perspective since COVID, when every production was shut down.
Stephen, what's been the conversation with SAG-AFTRA? Or I guess the question is, have you had a direct conversation with them? It sounds like there is some kind of partnership that's happening that allows for actors to be able to use, what they get from Cameo for Business to work towards those hours needed for health and benefit.
Yeah, that's exactly right. One of the things, back to your earlier point about, the public being really supportive of the actors here. 86% of SAG-AFTRA members did not qualify last year to meet the $26,500 threshold to make them eligible for their health care that they get through SAG. This has been a big problem. SAG has long been looking for other ways to give their members qualified earnings. And before the strike, a few months before the strike, we actually struck a first of its kind partnership where the earnings that talent make from Cameo for Business actually accrue to their pension and healthcare benefits. So this is a really big godsend to actors that otherwise aren't able to go do Comic-Cons anymore. They're not able to do merch drops if they have IP related to movies. They can't do personal appearances in many cases. So this has been really huge for them to be able to come back to the Cameo platform, engage with their fans, and earn a living.
Are you concerned at all that once the strikes end, you'll see a significant drop off of those participants, especially those more high profile names?
Look, we've seen this happen, as different things happen, whether it's COVID or, the disaster of the day. So anytime there's a natural disaster, for example, we'll see talent join to raise funds for things like the Maui wildfire or the hurricanes that are going on in Florida right now. So this is business as usual for us. On the aggregate, though, once people join Cameo, they tend to really like it. And our year gets busier and busier as we get towards Christmas. So, any pull forward that we see right now in supply side acquisition will be, good for the business in the long term.
Steve, to your point, you have seen the highs of the highs, really at the peak during COVID, to the lows where you've had to undergo a number of rounds of layoffs in terms of your employees. This has got to be a positive, and I know you're saying this is temporary, but how do you as a company ride this momentum when you've got more eyes on the platform right now to try and keep this going?
Look, we've struggled with a lot of issues, just like other tech companies, that had big bumps during COVID. If you look at how our business was before COVID and where it ended up today, I think anybody would have taken that straight line back in 2019 to where the business is in 2023. But when you go all the way up and have it come back down, it's certainly a much more turbulent path than we're all thinking. As far as what this means for our team, look, we have a small but mighty team right now, but this is just more evidence to all the talent on the platform, our investors, the industry in general, and our employees. Cameo's really become like a public utility in Hollywood. We're there in the good times, we're there in the bad times, and it really is a platform that matters, and that's the thing that is probably most important to our team going forward, and it's what gets us up to go work hard every single day.
I myself, Steve, I've purchased 2 Cameos in my life. They were for two different friends, pretty far apart. But it got me thinking about how the novelty sort of wears off after you buy the first one. So what ways are you working towards to try and attract that repeat customer? Is that an issue you're facing at all?
Look, we at this point have sold, single digit millions of cameos. So there's 8 billion people in the world, and I think we have a long way to go before Cameo doesn't become special. We get the reaction videos every single day, and the brand awareness is only 14%. Only 14% of Americans in our core demo know what Cameo is and have unaided recall of it. So we've got a ton of upside to go on that front. But you have asked a great question, and so much of what the effort that we are working on right now is seen at retaining talent and retaining customers and making sure that they have an insanely delightful experience. And again, that's what we work towards every day.
Steve, you've been very transparent about the challenges you've had to face in your company. And to your point, I mean, sure, you're not the only tech company that really scaled up massively during the pandemic and have had to downsize in a big way. When you think about where the company is right now, is this kind of more in line with how you want to grow? In other words, it's not a company where you had hundreds and hundreds of employees. You've got a limited number. You're a smaller operation. But is this sort of more in line with how you envision the growth to be?
Look, the company's lean and mean right now. We are on path to be break even very soon, which is a huge milestone for us. This was a business burning millions of dollars a month only a year and a half ago. So we've taken huge strides. We've got a small but dedicated team that is fired up about our mission. They love our vision. They love the culture that we have here. So, we're doing everything that we can to make sure that this is as fun and a rewarding a place to work as it possibly can be. And we want to make sure that from our customer side and our talent side, they don't notice any degradation of having a much smaller team. And, huge props to everybody on our team that's really, been doing the job that many people were doing to keep it business as usual for everyone, especially during a period where we're seeing a big spike.
And to follow up there, Steve, you've made some recent acquisitions like the celeb merchandise platform Represent. Is there more M&A in your future?
Look, our ears are open, and the whole larger creator economy. I'm an investor in a lot of the companies, that are there. Right now, if you're not an AI company, it is tough to raise money, and I believe there'll be a lot more consolidation in this space over the next 18, 24 months. So our ears are open. We're constantly looking for things that can help with distribution that are accretive to our core business, and we'll continue to be aggressive as we can be.
And that was Cameo CEO Stephen Gallant speaking with our own Alexandra Canal and Akiko Fujita. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
I'm Brian Sazia, Yahoo Finance here, and there is no Labor Day ice cold brewskis for me. No tomahawk steaks, no hot dogs, no burgers, no coleslaw, no nothing, because I'm getting ready to fly out to the Goldman Sachs Communicopia Tech Conference. Big name there, but that is because it is a very big conference. A couple things we'll be talking about at this conference: AI, and big deals. And to bring all those things to life, you have a lot of big guests on tap all week, live on Yahoo Finance. I'm missing my Labor Day to go out and report from this conference for 3 days. I suggest you tune in if you want to make a lot of money.
Social media has a big impact on shopping decisions. According to a recent survey from Charles Schwab, more than half of Gen Z respondents say they made purchases based on what they saw friends and other influencers share on social media. So now retailers are looking to tap into those Gen Z shoppers to drive business. Yahoo Finance's Brooke DePalma is here with the details. Hey, Brooke.
Good morning, Brad. That's right. All retailers want young people. They want them in the stores. They want them to shop online, and they want them to then share their favorites on social media in what many users are calling hauls. Now, one TikTok user that I spoke to, she works in social media marketing. Her name's Maddie, and she shared many hauls, from Abercrombie & Fitch hauls to Amazon, to Gap, to Target hauls, among so many others. And she said that she finds herself so easily influenced from other people's videos, and it makes her feel more justified in her purchasing decisions. Now, retailers certainly looking to tap into that and tap into this generation when they look to spend back to school or just in general as a new season approaches. So forget the loud music, forget the fierce cologne smell, and models at that Abercrombie & Fitch entrance. The CEO telling Yahoo Finance that they hope that they develop loyal customers in their mid to late 20s, especially young millennials, that they hope stick around in their 30s and then 40s. In addition to that, we heard from other retailers this past earnings season about the potential that young consumers have. Kohl's, which has struggled in recent years, is now getting a boost in sales as well as foot traffic, saying that their Sephora business, which is located inside the stores, attracts a younger, more diverse crowd that they're hoping to bring in further into the stores. And another one that mentioned consumers, young consumers on their call, is Nordstrom. They said that it's a bit of a evergreen opportunity, but they said we do need to do better when it comes to young consumers. And so why do they want this young consumer when they actually have the least amount of savings in their households? Well, they're setting the trends. That's according to one analyst. They said that really these young people, as we've heard in many years before, just now, they set these cultural touchstones that older generations then pick up on. And now, thanks to social media, like we saw before, like these hauls, just one item, if it goes viral, it has the potential to create a tsunami of business, not just for these big box retailers, but we've seen small businesses really take off on social media as well. And in addition to that, it really does depend on the situation of a young consumer, but many people in their young 20s don't have a lot of overhead costs, and a lot of them have disposable income that is then going towards buying merchandise. And so it really looks like here, Gen Z has the power when it comes to retailers.
It's true, because I mean, I'm certainly seeing more, whether I'm shopping online or in store, seeing these as seen on TikTok or as seen on Instagram, things popping up, and they just go flying off the shelves. So then if you're an investor, then how should you be thinking about this?
Yeah, well, one conversation that we continue to see come up, or one stock that we continue to see come up, is Lululemon. Of course, they came out with earnings yesterday afternoon, but they're really getting lots of attention from young consumers. And one Barclays analyst that I spoke to said that if you want to jump on a brand that is gaining that social media hype with innovation and new products, you want to think Lululemon. In addition to that, you also want to think Nike. They continue to make strides with young consumers, as well as continuing to diversify their portfolio to meet what's next. Now, if you want to jump into brands that adhere to health and wellness, active lifestyles, you're going to want to think those are on the screen. Think Dick's Sporting Goods, think Lululemon, think Nike. Also think Ulta as well. And one more for you. If you want to lean into brands, or invest in brands rather, that are really looking to help Gen Z stretch the dollar as their wallets remain pinched, we want to think of those off-price discount retailers. So we're going to think TJ Maxx as well as Ross stores. So there's lots of ways to invest in this perhaps newfound behavior of young consumers, but lots of businesses to follow as well.
Appreciate that update, Brooke, there for us. Thank you so much. Well, Lululemon shares are moving higher today after the athleisure brand raised its full-year outlook on strong revenue and a 61% jump in China sales year over year. And as we head back to school season, or our next guest says Lululemon is one of the best positioned names despite a challenging retail environment. Abby Renkes there, Piper Sandler, Senior Equity Research Analyst, joins us now. Thanks so much for joining us, Abby. So how is Lululemon better positioned than others, especially in this back to school season?
Yeah, so I think that Lululemon, consumers are being very selective right now, like where they're deciding to spend their money. And so I think that Lululemon, the differentiator is that they have the product that these consumers want. They have comfortable, innovative newness that they're bringing to the consumer, and they're marketing that, to these younger consumers specifically, and why I think they're positioned well for back to school. So we're seeing a lot of social media marketing, leveraging those like TikTok influencers, merchandising the website by, with a back to school page, showing strength in, accessories like backpacks and things that are necessary for those consumers. And so we think that's continuing to drive demand.
Abby, is Lululemon the perfect type of play or perfect type of positioning amid a quiet luxury trend that we're seeing right now?
I think so. I mean, I think especially for these younger consumers that we're talking about, Lululemon is aspirational. It's a premium price point. You're very proud to wear that Lululemon symbol on the back of your shirt or your leggings. And so I do think it is a way to play that quiet luxury. It's kind of that, if you know, like the scuba jacket is cool.
The scuba jacket? I haven't even seen that yet.
You should check it out. It's very soft, very popular with the younger consumers.
And Avi, I want to ask you some of the risks potentially to your price target and your overweight rating that you have on Lulu. I mean, China is also on that list, perhaps because of some of the uncertainty, but also things like FX weighing in with currency changes, as well as, of course, top of mind for people, inflation. What do you see as the biggest risks to the price target going forward?
Yeah, I mean, I think it is, we saw the entire athletic apparel industry slow down in the second quarter, and Lulu was able to gain share amid that slowdown, which allowed them to continue growing. I think that the longer term, kind of bear thesis or risk to, upside on the stock is that there just isn't the same amount of growth in the athletic apparel industry, and that there's other competitors taking share. Our thesis on this is that, there are smaller competitors taking a lot of share in the space, but, we're going up against these huge incumbents too, Nike doing almost $14 billion in apparel, Adidas doing almost $9 billion in apparel. And so we think that that's where, Lulu can continue to take share as well.
Abby, you are right. I do like this scuba jacket. As I think more about where Lulu has continued to invest, it's footwear. Is that paying off for them right now?
It's still a very small piece of the business and won't be a necessary element for the business to reach these Power of 3x2 goals that they have set. But we do think that, early indicators are positive. They're going to launch men's footwear next year. To date, it's only been women's. They've gotten some really good reviews in the women's running space. And so small right now, we don't think it's necessary to the long-term story, but, an interesting addition, to be able to outfit their consumer from head to toe.
And Abby, we talk a lot about innovation when we think of Lululemon. What do you think is going to be the next phase that unlocks? Because obviously they have, some of their pre-worn products to kind of sort of get people in the door as well. But what about those who'd like to be at the front when it comes to Lululemon?
I think that two recent launches that are really interesting within men's are the launch of Soft Jersey and the launch of Steady State. And so to date, in my opinion, I think that Lulu has done really well in men's on, performance, and then on, kind of this like business casual, what they refer to as on the move, like the ABC pants that you wear into the office. And so this kind of white space in the middle is this like versatile athleisure, which those two new launches really serve. And so I think that just gives, more use cases for their male consumer and should be able to, power further growth in the men's business.
For years, Lululemon has looked at some of the different markets around the world and said that we can lean into yoga culture there. That's clearly paying off in China. China has a yoga culture that is very strong as well. But now a lot of attention has shifted to pickleball. Can pickleball be a wind in the sails for Lululemon?
I mean, I think so. I think, more and more people are playing pickleball. Tennis skirts in general and tennis apparel has just seen, a surge in popularity recently, even for just, taking a walk down the street. Sometimes I'll wear a tennis skirt. And so, I mean, I think that there is, more pickleball consumers. They will need outfits to play pickleball in. And so I think Lulu's recent launch of tennis, should, be able to capitalize on that increase in pickleball participation.
And as you look at some of the biggest competitors like a Nike, what do you think is going to perhaps move some of that market share more towards Lulu when people are very price conscious at the moment? You have consumers trying to pull back. What do you think is going to help them gain market share from some of the rivals?
Yeah, I mean, I think it's all about that innovation and newness and having the best performance product, because, even in this more athleisure lifestyle segment, consumers are demanding like the best technical performance. And so I think that's where Lulu is really differentiated. When I go in my closet to say, what am I going to wear to, go on a run later, I always reach for my Lululemon stuff because it is the best, technical performing materials and fit out there. And so I think that's where they'll continue to take share and just, increasing brand awareness and, getting new consumers into the brand to see that's why it's differentiated.
For the results that we saw out of China and the growth there specifically, Abby, is it as simply as saying or perhaps applying the transitive property from what Lululemon saw to other athletic apparel and footwear companies like a Nike, like an Under Armour, like an Adidas?
Yeah, so I mean, I think in China they're using a similar playbook that they did in the U.S. of really forming a community there, which I think is very important. Really having a community out of the store base, and I think what's important there is that 2/3 of the stores in China have been opened since the beginning of the pandemic, which is obviously China's been very impacted by lockdowns, store traffic obviously impacted by those lockdowns, and so we think as they continue to build the community around the stores and grow brand awareness, that's where there's really an opportunity for Lulu to use the same playbook that they did in the U.S. in that market as well.
Abby, just lastly, while we have you, we were talking about Gen Z a moment ago, and I mean, I guess I age myself as a millennial, but at the end of the day, Gen Z being very attracted to not just communities, but also what their influencers are purchasing. And we've got an entirely new wave of some athletic apparel companies that have been driven by influencers, whether homegrown or just marketed through. I mean, Gymshark, my goodness, amazing growth that we've seen there. So all that considered, is it clear that as we see some of those influencer-driven or grown brands in athleisure start to get even more funding, start to grow out and amass larger fanfare, that Lululemon's market share is at risk, or is that just kind of something that they've been able to cement and carve out for themselves?
Yeah, so I mean, it's interesting because I think we obviously hear about these small growing brands, but when you look at, we do a Piper Sandler teen survey, and it actually shows that Lululemon is the third favorite brand among all teens. Among upper income females, it's their favorite athletic apparel brand. I think it's the second favorite athletic apparel brand among men in that category. And you're not seeing those smaller brands yet appear in those top 10 rankings. And so we'll continue to monitor that, but we do think that there's still a lot more opportunity to take share from these bigger incumbents, which is what we've seen in our teen survey, which is Nike, Under Armour, Adidas. That's where the majority of the athletic spend is now. And so we still think that there's a lot of opportunity to grow. Unaided brand awareness is still only 25% in North America, in the single digits in most of their international markets. And so I think that's where there's an opportunity.
And Abby, as we've seen from a lot of retailers, shrink, whether it's obviously theft has been taking a lot of the headlines versus damage. How is Lulu managing that?
Yeah, they actually didn't mention anything about it on the earnings call, and that's something we'll want to, dig into with the company. But I do think that there are certain categories that are probably more prone to theft. I think sneakers, that we've seen at Dick's and Foot Locker, they have there's an easy resale market for those products, and maybe less so for Lululemon goods, which is why we think, they might be less targeted than other peers.
There's a lot of athletic people in those Lululemon stores. You're going to have some spin move combos to get out the store and contribute to shrink there. Abby Ismaniak, who is the Piper Sandler Senior Equity Research Analyst, joining us here today. Thanks so much for the time, Abby. We appreciate it.
Thank you.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Have you tried pickleball yet?
I have not tried pickleball. I can't move left to right. My knees are shot from too many years of playing soccer and skateboarding. So I can't do pickle, but I can play plenty of golf.
Plenty of golf. All right. Well, I'll meet you out there then. We'll have a great deal of time there.
Big news in the world of cannabis. The Department of Health and Human Services recommending that the DEA significantly loosen federal restrictions on marijuana. The agency pushing to bump down the drug's classification from Schedule 1 to Schedule 3. Now, the DEA will make the final decision, but if the proposal is accepted, it could open up new avenues for marijuana research and mean big changes for how weed is regulated and taxed. But what does this potential shakeup mean for the industry?
Yeah, big question there. Curaleaf, a big player in the world of weed. The company has operations in 21 U.S. states and 8 European countries. Stay tuned. We're talking with the CEO, Matt Darin, on all of that and more. That's next.
All right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Have you tried Threads yet?
I have not. No, I have not. I hear good things though, so I'll leave it at that.
Okay, it's early days. I know I was in the tens of millions that first signed up for it, so I guess that's all I have going for me right now.
Well, if you're an active user, then you can coach me on it.
Okay, I will report back on that.
Cannabis has become a rather contentious topic in the United States as it walks the fine line of legalization versus criminalization. And the future for cannabis is being called into question once again. But this time it may be a little more positive after a new request from the United States Department of Health and Human Services. Here to join us to talk about the cannabis market and how this latest call may boost the industry is our very own Anjali Kemlani. Hey, Anj.
Hey, Rochelle. That's right. Of course, we know about this news from the health department yesterday, confirming that it has requested the DEA to reduce the schedule of marijuana from a Schedule 1 to a Schedule 3. So what does that really mean? It means that, Schedule 1 is what a drug is indicated as highly addictive and doesn't have any medical or allowed medical use. Schedule 3, however, does indicate that it's less addictive and could have some medical use, which is something the health department is looking into with some research. But it does mean that it's still illegal, federally at least, to grow or sell the product. However, it could open up doors for more research, especially in that medical space, and possibly give more of a pathway for companies to ease up with their banking needs. So that's where the positive indication comes from. However, of course, as you mentioned, this is something that the DEA still has to make a firm decision on. And it is something that we've already seen across the board in many different states and within state boundaries, even just a variation of what the legalization or the legal standing is of the use of marijuana. So it should be interesting to see how this plays out.
And Anjali, how does this new request from the HHS impact the cannabis market moving forward?
Well, I almost feel like this is a little bit of history repeating itself. But what most people maybe don't know is that marijuana was legal for a while in the U.S. In fact, it was on the formulary, and doctors used to be able to prescribe it. But in the 1930s, that started to shift. We saw a tax increase and basically prohibiting it from use outside of medical uses. Providers and distributors, physicians even had to pay that high tax. And then we saw in the 1950s that first move to criminalize it, so punishment for excessive use. And then in the 1970s, of course, we know that's when it became a scheduled substance. So now we're looking this many decades later at sort of possibly reversing history. I mean, we've already seen, like I said, that move around the states and counties even, or even at city levels around the country. We're already seeing that opening up, that loosening for room for all of these cannabis growers as well as companies to open stores, retail stores that are outside of the medical use. Recreational use stores have popped up in many states and many cities. So this could help along with that and just give these companies more of a market to look at here in the U.S. On the news of that health department request, we saw those shares pop of those companies. So likely to see that continue in the near future.
All right. Yahoo Finance's own Anjali Khemlani. Thanks so much, Anjali, for helping set up this conversation for us, as the history of cannabis in the United States is actually rather old. The first ever legalizing and legal concern, the drug dates the 1600s here. Now, where then the colony of Virginia required that every farm grew and produced hemp. The use of cannabis was fairly wide from that point on until the 1930s, when the government enforced the first restriction, the Marijuana Tax Act. It prohibited the use of marijuana federally, but allowed for medical usages. Since then, cannabis has largely been in debates, with some thinking it was a gateway drug, classified as a Schedule I drug, like that of heroin. Now its popularity and use is growing, as seen in a recent Gallup poll in August. And in early 2022, the MORE Act was passed in the House, which, if made law, will decriminalize marijuana federally again. Let's bring in Matt Darin, the CEO of Curaleaf, to give us his insights into running one of the biggest cannabis companies in the world and in the U.S. and the future of the industry here. And Matt, perhaps we just start off with what this reclassification would mean for your business.
Look, this is really a historic development that is extremely encouraging to see Health and Human Services make the recommendation to the DEA to reschedule cannabis into a Schedule III drug. It's long overdue because most Americans have known for a long time that cannabis, in fact, does have medicinal value and should not be on par with substances like heroin and ecstasy. But it's encouraging to see the federal government now coming around to this determination, and we're optimistic that the process is going to move forward here soon.
And for people who aren't familiar, what some of the things that come under Schedule 3, that includes things like Tylenol and codeine as well there. I do want to ask you, because obviously there's two parts. There's the criminalization part, and then there's the banking legislation part that have really been some of the biggest hurdles for the cannabis industry, really waiting for that catalyst to be overcome there. How much of a catalyst do you think this is going to be if the DEA does give its final say?
We think this is going to be a massive catalyst. The biggest impact from a financial standpoint will be the removal of the draconian 280E section of the tax code that has really become untenable for our regulated industry. Regulated cannabis companies today pay effective tax rates, many cases in excess of 70%, which has really become unsustainable as our companies have grown. So it's going to be a huge catalyst to remove the 280E tax and allow companies to really put those dollars to use into research and development, more investments into capacity improvements, and hiring and creating more jobs across the country.
What type of immediate investment into scaling up your business would you need to make?
Well, look, we continue to expand in a number of very critical markets in the 20 states that we operate in. So this would certainly give us the ability to continue to invest in cultivation and processing capacity as you have major markets continuing to expand, markets like New York and Florida and Pennsylvania and Ohio that are on the horizon as well for adult use legalization. It would allow us to continue to invest in research and development, which is a huge part of the industry. And there is so much untapped potential understanding the science of the cannabis plant and all the various medicinal benefits. And it would ultimately allow us to hire a lot more people, which we would love to do.
And as you mentioned, there's some of the economic impact that we're actually seeing potentially from the industry. I mean, jobs, you're talking about growers, what this could really open up here. For people who don't understand just how much the cannabis industry contributes to the economy, how would you sort of phrase this argument?
Look, cannabis has become a huge industry in the United States. So people estimate the overall cannabis industry in the regulated market and the illicit market is at least $100 billion, which puts it on par with other industries, such as beer and wine, et cetera. So today, the regulated market is only a fraction of that. As more states continue to legalize, 21 states that have legalized for adult use, 39 states for medical, we're continuing to see a movement where cannabis use is coming into the regulated market, where it can be safely distributed, manufactured, and ultimately taxed. And so it's become a huge industry. And states like Illinois today collect more state taxes from cannabis than they do from alcohol, which I think is really misunderstood.
And so, Matt, when we think about the accessibility, I mean, what type of accessibility difference would people see if this was reclassified to Schedule 3?
Well, I think the federal government recognizing cannabis as a Schedule 3 drug, I think there's still more questions and answers today in terms of all the various effects that will come from it. But there's no question that the federal government providing legitimacy and recognizing that this is a legitimate industry that is here to stay is going to ultimately provide a lot of support for the industry as more states continue to legalize for medical and more states transfer from medical to adult use, as well as many adult use markets that are still in the early stages and that have a lot of room to grow as more distribution outlets open up and as more capacity comes into the market. So we're still very much in the early stages of this industry, and it's been held back by things such as the 280E tax. So this move will ultimately, I think, provide so much support to the industry to allow it to really grow and prosper, which it already has, but has really been inhibited by some of these draconian laws that have been in place.
And Matt, I want to ask what this might mean for some consolidation in the industry, because, I mean, even with the regional banking crisis, it was a lot of these smaller banks, regional banks, credit unions that were helping fund and lend money to some of these smaller businesses that were in the cannabis industry. Do you expect then more consolidation and perhaps any companies that you have your eye on?
So today, the cannabis industry is very fragmented. It's still a state-by-state industry, and many states have limitations on the number of licenses that you can hold, whether it's in cultivation capacity or dispensary outlets. So I would expect you will continue to see consolidation take place in the market, as you've seen in virtually every other industry in America. How that plays out is really going to be subject to many of the regulatory changes that are going to be on the horizon. But we do expect to see more consolidation happen. But it's a big industry. And I think one of the things that makes it great, and that moves like removing 280E and safe banking is going to do, is going to allow it to be more accessible for entrepreneurs up through multi-state operators and everybody in between. It's a big enough industry for everybody to have a place in it once some of these prohibitions are taken away.
When you think about your own product assortment, there's been kind of this acquire to get more licenses strategy that much of the cannabis industry has had to go forward with at this point. Are there any acquisitions, are there any more deals that you would expect the industry as a whole to really move forward with swiftly? And is there one that Curaleaf eyes up should we see a reclassification come forward?
Look, we are always opportunistic and looking at opportunities across the entire cannabis industry, both in the U.S. and internationally, where we have major operations in Europe. So we are always out looking at opportunities, and they are abundant. But right now, we're really focused on the business that we have and continuing to execute. And I think we're excited about some of the positive catalysts that are on the horizon between the rescheduling along with safe banking, as well as some of the major states that are on the horizon to hopefully legalize for adult use, places like Florida and Ohio and Pennsylvania. So there's a lot on the horizon today, but I think more and more opportunities coming. You have many strategics and other industries that have been circling around and in some cases, taking a step into the cannabis industry. And I do think the federal government, legitimizing the industry is going to open the doors for many more strategics to get involved in this industry, which will be great.
And Matt, just quickly, in terms of the sort of competition then that this could potentially open up, for rivals of Curaleaf, how would you really differentiate yourself?
Well, Curaleaf has had a focus, first of all, on innovation and research and development that's really in the DNA in terms of advancing the science of cannabis. One of the results of cannabis being a Schedule I drug is there's been a lot of prohibitions on actually being able to research the cannabis plant. But we have some already tremendous research and development work that we have done over the years that has gone into commercializing a wide array of medical and other cannabis products. And so that's really been part of our DNA from the beginning and something that we continue to invest in because we see just tremendous opportunity as the product categories open up and as there's more ways to safely dose and use different form factors and identify different minor cannabinoids that we find have tremendous medicinal benefit. But a lot more research needs to be done to continue to get there. And I think that's one area of focus of ours, both in the US and in Europe, is to continue to advance that ball, because that's where we see a lot of the opportunity in the coming years.
We certainly look forward to having you back when we do get that final decision from the DEA. A big thank you for joining us this morning. Curaleaf CEO Matt Darin, thank you for your time and have a great weekend.
Thanks for having me.
Well, that's all for us here at Yahoo Finance. I'm Rochelle Akufa alongside Brad Smith, and we'll be back with you next week. Enjoy your long weekend.